going to do. I hope you enjoyed yesterday and the guest speakers and all that sort of stuff. I think they were very good, I think, and got a good lineup today as well. So you've just got we've got a couple of sessions on valuation, which is the sort of next step, and then we're into sort of one case study, which is going to be the first session, well, the third session of the day, where again we have the person who was the protagonist here, which is the fabulous case. And this is actually the first time we've managed to get Jason Goldberg involved. That's partly because he's based in Berlin, and so normally it's pretty well, we normally don't have video enabled things in California, so we're now going to have him in Berlin being interviewed by Alan in California, because Alan was clearly an investor in Fabulous. So that'll be the sort of looking at pivots, which is clearly a sort of, you know, big issue for many entrepreneurial ventures, that, you know, you're sort of providing money, but you don't quite know what you're investing in until quite late on. And that was very clear also from Slack yesterday, where, you know, they were trying to build a video game. So they, you know, trying to build a video game, but they end up creating Slack, which is sort of really striking. If you're thinking about going back to what I was saying right at the start about being a VC investor, is a bit like, you know, investing in options and investing in people. Maybe that makes the point as powerfully as anything, that, you know, the investors were basically saying, we sort of trust you, go forth and do what you can. And you know, it's a bit bizarre in a way. They sort of said, it sounded like the investors never really believed in the game. It was interesting that I thought that Cal never actually told us what the game was. And, I don't think he ever has told us what the game is, has he, Kathy? You're on mute, by the way.
No, he's never said. But I think he's when he's so enthusiastic about the story that you get carried along and then forget to go back and ask. So perhaps we should ask. And I haven't seen anything on you know, looking at news stories about it.
No.
But of course, Flickr was very successful. So they were a success. That they were on a roll, weren't they?
Yeah, I think that's the point, and it's a bit depressing if you haven't had a successful entrepreneurial venture. But you know, because they had Flickr, they got their game funded. The game didn't work, but then they used the funding then to do Slack, which is a sort of, you know, this is not like a one-off. This is actually pretty typical. And actually, you know, a bit like with Jeff, you know, they were sort of doing a bunch of different projects, and then just on the side, because he didn't really say this, but two of his other founders were sort of serious gamers as well. They loved going to these game conventions, and they just did it on the side. Came up with an electronic sort of brochure or you know, it's sort of, you know, an app which in place of the paper sort of folder that you got from the conference. And so again, it wasn't what they intended to do, but they said they got such a good response to it, they just basically said, we'll do that instead. So this is sort of serendipity, and it's almost like, you know, you're sort of funding one thing, but you may end up along the route discovering something which is much better than that. And I think that's one of the sort of frustrating things here, is that, you know, if you go in there, you go in as an entrepreneur trying to raise money, and they're looking at it as much as like, do they want to fund you as do they want to fund your idea? And funding you can be difficult when if you haven't had prior experience. And that's why sometimes it makes sense, you know, to maybe hook up with, if you can find co-funders who have got that little bit of background and experience. You know, it doesn't even have to be the most successful thing. You know, sometimes it's just you came up with an idea, it was moderately successful, you sold out to a competitor. That can be a good story as well. I think that there is this feeling that, you know, it's much easier to raise money once you've raised money before.
Yeah, it's a whole track record thing, isn't it? Which is hard. It's hard to get that track record to start with, but just one thing will make a difference. I meant to ask Cal yesterday and just forgot about the Amazon partnership. So Teams is doing a lot better in lockdown, and you know, and obviously there's Zoom, but they have done a deal with Amazon.
Oh, really?
So all of Amazon's workers will use Slack. I think the BBC uses Slack as well. All of Amazon's workers will use Slack, and they will also partner on some projects. So that's their sort of, which he didn't go into, but I think it's an interesting sort of hedging strategy, you know, given the rise of Zoom and the fact that Slack is very, very different. I don't know who uses Slack. Use the reaction button and put your hand up if you use Slack. Anyone use it regularly? Yeah, Brendan does.
Only a couple.
Yeah, not that many.
Yeah.
Interesting.
Yeah. Anyway, so we've got another. We've got the third session will be looking at this whole pivot issue in a bit more detail, because that's not really the point of the Slack one. Actually, was the pivot, but you know, they clearly did pivot halfway through. So that's really sort of the horse or the jockey. Our issue is what we're going to look at in session 3. Session 4, then we're going to look at how angel financing actually happens, and this is you know, looking at the using AngelList as an example of that, because they are, I think, you know, they are the sort of dominant network in the US. There are others as well, but they do it in a particularly interesting way. You know, they were an interesting case because they started off again doing it as a sort of, almost like a Craigslist for startups. And it wasn't originally a business. It was like, we're doing this for the community. And actually now, if you look at AngelList, it must be worth quite a lot of money, because as you will see, their business model is quite, you know, means that they end up taking small stakes in everything that gets funded through their network. So they have a small slice of carried interest on everything that goes through their network. And if you take the view that, you know, one in a thousand of those is going to create super high returns, 1 in 1,000 will make them rich, and they'll make nothing on, you know, on maybe 500 of them, and you know, and some of the others may make some money. But it's a nice model when you end up with a slice of everything. That's if you can do that. There's very few businesses which get, or VCs can get a slice of everything, and they don't get a slice of everything because not everything goes through the AngelList network. But it's certainly something that's worth finding out more about, because they are a very important player here. And then the final session of today will be, as I said yesterday, it's essentially a talk with a smaller VC fund, a relatively new VC fund, but one which is where you've got a relatively new person in terms of Marianne Saenko, teaming up with a sort of titan of the industry and launching a fund. So that should be interesting. So any questions at all before we start on today's today, which is really about valuation? Is there any questions? Could we realize, you know, with these things, you go through it quite quickly, everything, you know, you're trying to stick to a timetable. We're fine on the timetable. So, you know, if there are any questions anybody's got, or any terminology we've used that is confusing, and, you know, almost like anything at this stage, it's better to ask now than to go through saying, you know, what the hell did that mean? So I would encourage you, if you've got any questions at all, to ask them at this stage. And
I think Fabian has.
Okay, Fabian, go ahead.
Oh, you're on mute. You're on mute, Fabian.
He was. Let's try again. It looks like you're on mute now. Okay. No, still not working. Gonna maybe try reconnecting to audio. But is there any other? Yeah, Paoli.
Yes, I got a quick question. Yesterday, Alan mentioned that there are only 100 angel investors in Silicon Valley. for me that 100 number is quite small. Can I just ask, is that 100 is individual person or angel funds, or what's that like 100 come with?
Yeah, I think what he was saying there, and I agree with you, is it was a slightly surprisingly low figure. I think he was sort of saying 100 that matter is what he sort of was saying, I think, because he was sort of saying like 5 law firms matter, 10 accounting firms matter. That's not to say there aren't a lot more angel investors, but I think what he's sort of saying is that, and you can see it a bit with on AngelList, that on AngelList it's done by, you have these people called syndicate leads who essentially are the front person. They're the lead investor for a deal, but they're not the only investors in the deal. So they might, in any one deal, there might be another 10 investors who come in. And I think what Alan's saying is there's plenty of investors, but not all of them lead deals. They might just sort of invest alongside other people. And also, of course, angels is an interesting term because it actually spans a lot of people. So I would call Reid Hoffman currently also an angel investor. You know, he's clearly he's sort of impossible to categorize. You know, he's a very successful entrepreneur. He's a partner in a venture capital firm. But if you ask him, if you said, okay, you know, Reid, what have you invested in recently? Not through your fund, but like with Reid Hoffman's family checkbook, you'll find he's invested in loads of things. And again, having Reid Hoffman as your angel investor, that would be one that counts. So I think that's what Alan meant, was that, you know, there's quite a few angel investors, but there's sort of some that really matter and will help you get funded through the next stage. But I'm interpreting his slides, you know, that you can equally well ask him as well.
Yeah, can I just add on this quick question? In UK side, yesterday you mentioned there's a tax incentive for angel investor. So can I just ask, in UK or in US, the angel investor, they more exist as individual person or as a fund, as a company or partnership? How does that?
It's a good
investing.
Yeah. So the tax incentives certainly. Well, I'm not aware. Actually, other people, maybe US folks, will know better than me. I'm not aware there are major tax incentives for investing in the US, other than you can carry forward losses on investments and offset them against profits. But let me tell you a bit about the way it works. So in the UK, you can either invest through individually, and you can just claim it back on your tax return. So there's an element which says, you know, have you made any investments which are EIS, which is Enterprise Investment Scheme, or SEIS, Seed Enterprise Investment Scheme compatible, and you can claim those back directly on your tax return. There are certain criteria, so they don't want you like investing in real estate, for example. So they want it to be a real operating business to do that, and so there are various criteria, like it can't have more than, you know, 100. I forget what the numbers are, like 50 employees. It can't have more than 5 million of revenue or something like that. But equally well, there are some funds which get set up in the UK which essentially invest in EIS compatible investments. So there are certain intermediaries like Octopus Ventures and the like, and a few others, which will set up a fund. You invest in the fund. Octopus Ventures, you know, 1998. They tend to be very short dated funds because you claim the tax relief in a year, in a tax year. So unlike a normal 10-year fund, you sort of have to do it in slices of investment. But they might say Octopus Ventures 2020 fund, you invest in that, and then they invest in like 10 companies which are all compatible with the tax relief. So that's a good way to do it, because you get the portfolio diversification there and you get the tax benefit as well. So, you know, it's pretty popular actually, that whole side of things. And a big chunk of the investment going into UK startups does come through angel investors using this tax break. In fact, most investors will try to use this tax break until the point that it becomes, you know, the criteria don't apply anymore, the company becomes too big or the like. So it really drives the majority of it. Maybe I'll tell you a sort of what might be a marginally interesting sort of, you know, bit of gossip. I haven't given you too much gossip about, you know, my life yet, but so I finished doing the last course for the previous cohort, and immediately I spent basically April helping the government set up a co-investment fund which was trying to invest in UK startup businesses, because as in many countries, you know, there's furlough schemes, there's bounce back loan schemes, there's payroll protection schemes and things, but the UK government tried to help startup businesses which were finding it very, very hard to raise capital. Most of the angel investors and the VC funds were sort of not really putting money in. So the government announced that they were going to have what they called a co-investment scheme, which is called the Future Fund, which was going to invest in, co-invest alongside a VC fund, so pound for pound. So if a VC fund or one of these other investors put in £1, the government would put in £1 as well, with no questions asked. It was sort of automatic. They wouldn't do any due diligence. They would rely upon the due diligence of the investors. And interestingly, and this relates back to yesterday, the government wanted to structure it as convertible loan notes. In other words, what we were looking at yesterday in the guidebook case. And interestingly, that's a bit unusual because loan notes tend to be used only for first stage financings, not for later stage financing. They're there when you haven't really got a valuation. But the government didn't want to get involved. They wanted to make it automatic, and they didn't want to get involved in the issue of, I've got to value every single one of these companies that comes along asking for money, because you're worried that, you know, it's going to take too long and they're going to be dead. So I spent as I say, the first, you know, the April helping the government design its convertible loan note scheme to enable them to launch this fund, to make sure it was actually compatible with all sorts of things like state aid and can you create some strategic issues when you're having a loan note so late in the day. And it was all to do with the things we were talking about yesterday, valuation caps, you know, what interest rate they should have on the loan as well. And the fact that they were going to have these loan notes, convertible loan notes, were going to be quite long term. So they could last up to 5 years. So that's what I did in April, was help them on that fund. And they launched it about a month ago. And the 250 million they allocated to it was actually allocated in the first day. So that was a sort of rewarding thing about it. The bizarre thing was to clear state aid rules, I relied upon all the data I got from Kevin Laws. I said, how do I benchmark this against other schemes where normally these things are private? And I contacted Kevin, and he gave me all his data from the angel list network, anonymized, and that was really helpful. So it's one of these sorts of odd occasions where the people we get to teach the course actually helped solve a policy issue in the UK, which was a real sort of interesting and rather gratifying positive effect of teaching this course in California. But anyway,
and slightly worrying the ignorance of the British government, I think, but we'll brush lightly over that one.
Yeah, well, they were finding it very hard to get it through without some sort of evidence, and they didn't have enough evidence locally to actually bring in the scheme.
You've got a question in the chat, Tim, from Imane.
Right, I have not.
Around explaining the mechanics of, just going over again the mechanics of shares, pool, pre-money, post-money.
Sure, yeah. So, okay, so let's think about this. So the fundamental thing, and it's a bit philosophical this, but the pre-money valuation of any business is essentially, certainly before they've got money come in, is essentially the value of the idea and the people to execute that idea. So you're trying to work out, you know, what is this worth to invest in before I actually put any money into it? And that's why if you look at, you know, it's very, very hard to think about what that is, because very often you have literally no revenues or you have losses for the first few years. And so we're going to talk about valuation stuff today, but the pre-money valuation is philosophically the value of the people and the idea at that stage in prospect. So what do I think this could be worth? Understanding the fact that there's a big risk it will fail. Okay, so that's what we'll spend, that's pre-money. Post-money is just, I decide it's worth, you know, £6 million. I'm going to put in £1 million. And so after the money comes in, you've got the idea, the people, and £1 million. So therefore, you just add the two together. And so post-money is just pre-money plus the money. And when you're thinking about the share of the company you get, it's always the amount of money you put in divided by the post-money value, because you'll create shares in response to that money. There'll be some founder shares you have, which you set up the business with, and then you'll create more shares to give to the investor who puts in the £1 million, and then they own essentially their money over the post-money value amount of the company. So to keep it really simple, if you value it at 9 million, you put in £1 million, then essentially the investor is getting 10% of the company. Okay, so that's, if you like, pre, post, and the like. In terms of the sort of option pool, that's often done on top of it. So it's almost like you say, well, I want 10% of the shares in the company that's now worth 10 million, but I want you, as part of the deal, to create an option pool. But I'm still going to own 10% of the company. It's like, you know, the option pool comes out of you, the founder's share of it, right? And that does feel a bit weird the first time you come across it. So, you know, let's keep it really simple. Let's imagine there's 9 million shares to begin with. You then create 1 million shares for me, and I put in £1 million there. And I say, I also want you to create 1 million shares as options for new employees. Essentially, it's like 1 million of the shares come from you as the entrepreneur, and they are used to incentivize future people. Now, that feels a bit unfair the first time round, but actually the next time round, everybody gets diluted because you go through the same procedure again at the next stage. So, you know, say it's valued at 20 million and you do a Series B, then the existing investors, which will be the entrepreneurs and the Series A, will have to create the option pool, which will come in before the Series B money comes in. And so it's just convention. You could do it the other way. You could say the option pool will be created 1 second after the £1 million comes in, but it typically doesn't. It's typically not done that way. So I don't know whether that helps, but if it doesn't, you know, just come back to me, because I'd be very happy to answer it.
I think there's a couple more questions, Tim.
Yeah, I see that. So, yeah, Brendan's saying pre-money values, is it normally based on benchmark, especially if there's not income? Park that one. That's what we're talking about today. So I'll come on to that. There's a couple of hands up as well. Nick, did you have a question?
Yeah, thanks. So I was only just going to say, so we've really in the last few weeks been through this phase of doing a pre-seed investment round. So managed to convince our investors to do a post-money pool rather than a pre-money pool, although it doesn't make it vast degree of difference ultimately to us. I was interested, just because of your government connections, our investors actually decided that they didn't care about SEIS and EIS just because they wanted to do it quickly, and obviously they've got enough money that they don't worry about the tremendous tax breaks. One of the other rationales was or at least one of the guys was a bit suspicious about how long those benefits would last given the probable tightening of the economic situation. Do you have any insights into whether those, you know, really good tax breaks are going to persist as we get into maybe a slightly tighter financial environment?
Yeah, I think the tax breaks will stay, but don't hold me to it. But I didn't hear anything in any of the conversations that I had with Treasury that the tax breaks were going to go. They seem to be quite popular. The thing that really slowed this down you know, I tell you, so I'll give you a little bit more of the backstory. It's quite interesting, but we were approached on a Wednesday by the government, essentially saying, we need this to get through state aid clearance. Can you do it by Friday? And we sort of said, really, Friday? And they said, yeah, it's really important. We want to announce this. So we said, okay, we'll give it our best shot. We'll do it. We'll try to do it by Friday. And you know, it's like normal government procurement. If any of you have ever dealt with government before, it's normally like, okay, we'll send you an invitation to tender, and you can put in something. And basically, they said, how much is it going to cost? We said, we're going to work like 20 hours or 24 hours for 2 days. This is what it costs. They just said yes on the phone. That was it. This is a completely, you know, COVID affected thing. Then on Friday, we pointed out that they couldn't get. It was going to be super complicated to get the tax breaks for the individual investors and get this be not deemed to be state aid, because actually the tax breaks are deemed to be state aid by the European Commission. In other words, you know, within Europe, there's a lot of dispute about giving subsidies to firms, and not surprisingly, these tax breaks for angel investors and for startup businesses are deemed to be are deemed to be state aid, because they either sort of increase the value of startup businesses, or they're a subsidy to investors, and either way they're state aid. So we said to them, we can make this work as long as you don't have the EIS investors in there. If they're in there, we're going to have to look a lot more carefully. And we spent a couple of weeks trying to get the EIS investors in there. The Chancellor of the Exchequer was super keen to have them in, and basically I had to say, sorry, Chancellor, you can't have it. It's not going to work, not unless you want to take this to the European Commission. And so it wasn't compatible. We couldn't make it work for angel investors to get the tax relief. But in the event, the whole 250 million went on the first day anyway. So basically, we felt vindicated that it didn't screw up the scheme. There were enough people who were prepared to take the money on a non-tax advantaged route. Obviously, if we'd opened it up to EIS, it probably would have been 3 times as much that they would have needed. So it might come in the future. There may be another version of this fund actually, but at the moment it's not available to individual investors if you want to get EIS or SEIS money. So let's see. Any other questions on anything we've done so far? Otherwise, we'll start down the route of valuation. Okay, there is one other one, Fabian. Yeah, with your lack of microphone. If the financial capabilities of the target company are outsourced, how the VCs are monitoring the performance of them? Okay, normal practice for the VC monitors performance when they're or act when they're not performing. So yes, good point. So you might remember yesterday it was basically saying that you don't normally have like a CFO or things like that to begin with in startup businesses. And you might have a pretty stripped down finance function. You might even outsource that to, there might be accounting guys who actually work in the VC fund. Now, if they're working in the VC fund, then they've got all the data they sort of need anyway, so you don't need to worry about information flows. They will be super interested in lots of other metrics, like, you know, like user experience, like, you know, progression towards your prototype, like, you know, the number of hits you're getting or number of app downloads or things like that. So they'll be super, like VCs are very data demanding, I would say. But I think the point is that a sort of finance function that you're sort of paying good money for, like a CFO to go out there and sort of raise money for you, is very unusual. Like normally the entrepreneur has to raise the money. It's not like outsourced. And that's because they want to see the whites of your eyes and they're investing in you. So I think that's what they really meant. And of course, they will sit on the board as well, typically. Most of these VCs will take a board seat, and they will then create a formality which is, you know, pretty disciplined. I mean, certainly when I was sitting on the board of Verivox, we would have, especially during the hard times, we would have monthly board meetings, and we were constantly ramping up the data that they had to provide, to the point where they actually, because they were techie guys, they built real-time systems to generate this, and it would just sort of hit our desks. So they created a little sort of tool, which meant that we could go into a website and we could see the number of expressions of interest they had, the number of hits on the website, the number of page impressions, because at this stage it was sort of a prototype in the early days before they could actually monetize it. And you know, it started off being essentially a website fund or a business funded by advertising before it became something funded by switching costs, commission costs. And we had great data, and the VCs were very insistent on that they wanted to monitor what was going on. But you know, when you're, in a sense, when you've given them, like we had, I think, 3 million euros in our Series A round, and they did want to know what was happening to it, how much we had left. But it wasn't like they were really closely monitoring every penny we were spending or every cent we were spending. They were very exercised by how much the founders gave themselves. And they sort of insisted, a bit like Jeff was saying they worked for free, and Cal was saying they basically took as little as possible. That was pretty typical. I think they literally took like 20 or 30,000 euros a year each to live. And that was, there were times when we as the board were pretty worried that they, you know, they looked a bit hungry, and they looked like they were sort of, you know, they weren't taking enough actually to survive. So they were worried about that, but they weren't like focusing on, you know, financial metrics that much. It was much more how the business was doing. I hope that answers it. But if there's any other questions about like how does it really work in practice in terms of, you know, how does a VC sort of, you know, what are they really monitoring? I'm happy to answer that, and Alan as well. And so one from Brendan saying, well, with Brexit happening in January, do you think government want to invest more in businesses, as small businesses tend to be big employers in the economy? Yeah, one of the big issues, certainly with Brexit, is that the biggest investor in startup businesses in the UK is the European Investment Bank. So where we got our data from for that, for the fund returns, which I gave you, the EIB is one of the largest venture capital investors in Europe. And what the UK, and they will stop investing in UK funds. In fact, it's interesting, one of the assets which the UK has, which is going to which is being balanced against the liabilities to pay all the European pensions and things like that, is the EIB stakes in lots of startup funds. And the UK government has basically allocated all the money they were going to give to the EIB to the British Business Bank, which is now going to become like the UK version of that. And they've already set up a number of funds. I found out all about this in my work for the government as well, because they were saying, is this also compatible with a bunch of other like regional funds? They have these things called like Northern Powerhouse funds. They've got some based in the Midlands. They've even got one fund which invests in startup businesses in Devon, Cornwall and the Scilly Isles. Bet you nobody knew that. There's all these amazing funds which have been set up to invest in startup businesses around the UK. And those will, I think, will become, you know, I think more money will be allocated to those. In fact, you know, I think that was very much clear that they were thinking, even with this future fund which they set up, which, you know, that they were putting 250 million into it, and they said if you know, we can put in another 250, another 250. That at the moment it seems like there's not that much, you know, normal budget constraints aren't really applying. What's a billion here or there? You know, when it's 300 billion you're borrowing, you know, does it really matter? So and how do you get to know about the fund available in the UK? Look on the British Business Bank. That would be the place to look. That's where most of the funds are being allocated through. That's public sector money, but there's also loads of private sector venture capital funds as well. The UK is, you know, is one of the largest markets for venture funding in Europe. And so there's a very vibrant venture funding market in the UK. You don't have to go to public money. And indeed, there are some you know, there are some limitations to that, actually. Okay, so that's a little sort of update and a bit of roundabout on venture funding. But let's go into the main session of today, which is about valuation. So what we're going to do in this session, sorry, I'm just going to reorganize my screen so that you can see it. Get rid of the chat for a while. Okay, here we go. Let's do that. Okay, so this topic is really, so let's assume that you know where the money comes from. You've got your first convertible loan note, which doesn't require any valuation, but then you're going on to your first priced funding round, if you like, your Series A funding round. How do you actually value that? So, you know, the first place to start is, you know, in a sense, well, what's the value of anything when you think about it? And you know, in business finance, you talk about this, or in fact, in just life in general, you think about valuation. There's a couple of different ways to think about it. You know, at one level, it's the sort of, you know, the value of something is what somebody's prepared to pay for it, and that's worth remembering, because it's, you know, it is sort of saying that it's not necessarily, obviously that is a function of, you know, they will have to base their opinion on something, but there is an element of, if you're willing to pay, then it's worth that much to somebody. You know, there's obviously a DCF standpoint to this, in terms of what would I have to pay today in order to get my access to the cash flows of that company in the future. And that's what we do a lot of in normal business finance, in terms of, you know, you have a business which, you know, you're going to invest in some machine that will turn out predictably 100 widgets for the next 10 years, and you then DCF the hell out of it to get back to your value. But the problem is with early stage businesses is that is really the uncertainty about the cash flows, and that's what we're going to focus here on. And just going back to, I think I mentioned this in the chat earlier, but, you know, pre-money is the value of the, if you like, in entrepreneurial ventures, we've got a couple of different notions of value. One is the pre-money value, the value of the idea and the people. The post-money is essentially that pre-money plus any money you've got in there. But there's an additional thing to worry about here, and not worry about, but to be aware of, which is that the headline valuation isn't often the true economic value. And that's because in startup businesses, you have different classes of equity. And so normally in business finance, we think of debt and equity, and we're always thinking in the equity part of it as shares, ordinary shares that are the same. Your shares are the same as my shares. In entrepreneurial ventures, you basically don't have the debt, really, because you can't afford to pay interest payments, but you do have different classes of shares, and the price you see for one class of shares is not necessarily the right way to value the other shares. And so this, if you noticed yesterday, Jeff was alluding to this when we were talking about options. And just to be clear, the investors have preferred shares, and we will talk about those at great length tomorrow, because they're really interesting, and you've got to get them right when you go into this as an entrepreneur. The entrepreneurs have ordinary shares, and the investors have preferred shares. They have different rights, and as the name suggests, preferred shares have more rights to cash flow and control than the ordinary shares, so they must be worth more. So just multiplying the share price on the preferred shares by the total number of shares doesn't normally work. And we will just bear that in mind. We'll come back to that at various times. Now, did I see there's some chat here? So let me just see. What is these? Okay, good. You've sorted out your own problem. Perfect. In terms of the techniques we're going to focus on today, is basically three, or rather they're sort of two. There's discounted cash flow in the normal sense, and then we're going to look in a more in the VC world. You tend to use a sort of scenario-based cash flow. And the reason for that is because you're really uncertain about what the cash flows will be. As I say, normally in the sort of business finance course you do, you know, somebody will say to you, yeah, you invest in something and it will generate 100 a year for the next 10 years, right? Now, the problem is here is you have lots of uncertainty about the cash flows. And so that's really what you're dealing with. And we'll look at those two first, and then we'll look at a technique which is quite widely used, which is much more, it's not so formalistic in a way. It looks at it from the point of view of how much of the company do I have to own in order to make this worth my while, in terms of, you know, given the risks I'm taking, the risks that you may fail, what proportion of the company do I have to own in order to make this worthwhile for me as an investor? So it's sort of based upon ownership. It sort of backs out ownership. Value is the sort of thing that works out whether it's worth you investing in that company. And so we'll come on to the VC method, but that will certainly be after the break. Given we've got 15 minutes now for our first break, we definitely won't get to VC. Okay. So what I'm going to do for this is, you know, we're going to use an example in a minute, which is this Vino Veritas case study, which is actually fictitious, but it's obviously very close to many apps which I'm sure you and I love, like Vivino or things like that. You know, this is a recap, if you like, that from business finance, and I guess it's, God knows how long ago it is that you did business finance, probably a year, but let's, just as a recap, in order to do a discounted cash flow analysis, you need 4 things. You need cash flow forecasts, you need a terminal value, because at some point the forecasts end and you have to make some judgment about what the future value will be. You need a discount rate to discount the cash flows, and you need to think about tax. Right? They're the 4 things that you need for a DCF. By the way, I find it's always difficult to judge how much people remember of basic DCF. So I'm going to assume you remember most of it, or that when I say it, it'll sort of come back to you. But if I go too fast, just say, okay, because I can always rewind and slow down. So let's look at the Vino Veritas case as a sort of example of this. And as I say, this is completely stylized and fictitious, but it's there in order to sort of do something which looks reasonably sort of similar to the normal sort of cash flows you see on a startup business. So here you've got a company that's gonna have negative net earnings for a couple of years, and after a while, if it really takes off, its revenues really shoot up. It's got a sort of very scalable business model. You create an app, if you like. If it really takes off, then you can create a lot of revenues with relatively little incremental spend. Having said that, to get there, you're going to have to spend quite a lot of capital expenditure to do that. So you've got to fund your losses to begin with and your capital expenditure. Then you've got to think a bit about working capital needs. And this is set up slightly strangely insofar as there's a sort of cash need here for operations. But it's also, I don't know why I did it this way when I set it up, but this is a business which actually generates working capital to begin with. So it might be, for example, that you get some vendor financing or something, which, you know, you can get people to pay you in advance. So the first couple of years, the other working capital is negative, but eventually, like most businesses, as you grow, you need working capital needs for, you know, getting paid later than you have to pay your invoices, or having enough to pay payroll, the lumpiness of operating expenditures and the like. And essentially, as with all businesses, you have to think about working capital as something that you do have to finance, because over time, and here, over time, to begin with, it starts off as negative, which is nice, but over time it becomes, you know, a fairly chunky piece of cash that you have to provide for. And so in total, what you have to think about then is the cash flow needs on an annual basis is the change in your working capital. So that's why you sort of look at the, in a flow sense, the change in your working capital is what you have to finance over the years, not the stock. The stock is important, but it's the flow you look at. So in this case, this business has 4 years. If you add all those things together, so you take the earnings, you take off the capex, which you've got to finance as well. To begin with, you're lucky you've got a positive net working capital for the first year, but after that, that working capital needs to be financed as well. And you've got essentially 4 years of losses that you have to finance. And then you suddenly in year 5 turn into positive, and then year 6 starts to really sort of motor, and you end up with a business which is generating, you know, 1760 of sort of free cash flow at that point. You know, essentially what you have to do is to find somebody to finance you through those first 4 years. Okay. Now, again, I don't want to, these are just numbers, they're just made up, but that is sort of the way that many of these businesses work. You've got 2, 3, 4 years you've got to finance, but beyond those, it looks pretty good if you can get through. Okay, so that's what we're dealing with here. And so the question is, so how do you go about valuing a company like that? Well, as you can see, it's not the normal sort of company that you normally sort of look at, but you've got this sort of valley of death, if you like. If you don't raise enough money to get through those negative years, you're going to be out of business. So, for example, if you raised $500,000, then you're going to get through 2 and a bit years, and then you're going to be asking for more money at that stage. And that's essentially the way it often works, that you get enough to get to your next stage, see whether it works. The next stage, for example, would be, can you make, you know, do you get positive net earnings, for example, which should happen between 2013 and 14. If you raised $500,000, you might get to that stage, and then the investors might put in more money at that point. You don't normally get funded for 4 years. You normally get funded for about a year to 18 months. And that's, so you then have to go back and get more money. Okay, any questions about that before we just crank through some of the, you know, if you've got those cash flows, what do you do with them? Okay, let me head on for a bit. So, the first thing you have to then do is you have to estimate the discount rate. Now, this is sort of tricky in a way, because, you know, if you're thinking about the parameters you need in order to work out a discount rate, if you go back to your fundamental principle, it's all about risk, right? But remember what we thought, what your professors taught you about risk is, it's not like idiosyncratic risk. It's actually systemic risk that matters most, at least in theory. That, you know, it's how the risk fits into a portfolio. So we know these are super risky, but the question is, are they idiosyncratic? It's a bit simpler in some cases with startup businesses because there's no debt. We're just dealing with an equity cost of capital. Okay, and you need some sort of way to estimate that. So people use an asset pricing model like the capital asset pricing model, or CAPM. And for that, you know the inputs, if you remember these. You need a risk-free rate, you need a market risk premium, you need a beta coefficient. And you know, in a sense, the first two are not too tough to estimate. The real thing that a lot of people find quite counterintuitive here is, what is the beta coefficient? And we'll come on to that in just a second. You've got to think in terms of real or nominal. That's just a sort of housekeeping thing. You can work out your own revenues in real terms, in other words, not allowing for general inflation, or you can put your assumption about inflation in there. It doesn't make any difference. You just have to be consistent there. So it depends how you model the cash flows. We're going to assume here that it's a nominal number, so they've allowed for the fact that prices might go up a little bit over time. But if you were going to estimate the cost of capital for that business, knowing those are the parameters, what would be your estimate? If you just think for a second, you know. In fact, in chat, why don't we do this? This could be fun. I've not done this before. Why don't we just see what in chat? So you imagine that you were having to do a little DCF of that, and I haven't given you a huge, you know, all the data that you might need for this, but you know what it is. It's an app to estimate the, it's an app which is associated with wine, wine purchases. You see the business model from the case study. Anybody want to give any sort of suggestion as to what the cost of capital might be for that? I don't think I can actually look at, can I actually look at chat while I'm showing my screen? I'll try to work that out. Yes, I can. Here we go. So anyone who wants to put forward a suggestion, put in a number. That's all you need to put in. Is it 1%, 5%, 10%, 100%? There you go. We've got first one from Nick, 50%. Okay, that's a good starter for 10. Any other suggestions? I know where you're coming from, Nick, but I'm going to argue with you. 20. Okay, so we're going down a bit. Anybody lower than 20? So, well, okay, let's take Nick to begin with, because I want you to stay within, Nick, the your traditional business finance framework, okay, which I know I didn't quite tell you that to begin with, but how are you going to get to 50% within your the normal business finance CAPM framework, where you know that the cost of capital is the risk-free rate plus beta times the market risk premium? So what are you taking to be the risk-free rate?
I'm not, because it doesn't fit into that model.
Right.
So, yeah, no, the point is right, is what you've got to discount out the long-term cash flows by a huge amount, because they're so uncertain. Now, so the only way to do that is to have a really high rate. Yeah.
Now, I understand where you're coming from completely, and actually we're sort of jumping a little bit ahead to deal with your problem. We're going to use the scenario DCF approach, because I think it's always really tempting to think this thing has got a big tail risk that it could just fail, so therefore there should be a high discount rate. In some senses that's the right intuition, but I think the best way to deal with it is not to stick up the denominator, like stick up the discount rate, but actually to chop the expected cash flows. And so that's, I think, the better way to deal with it, because if you put in a very high discount rate, you might bias your decision making against things which might be like lower risk but have a very, the revenues are back end loaded, because 50% discount rate accumulates at a prodigious rate, and so you could end up making the wrong decision there. But I think the 50%, we'll sort of get to your answer, but we won't do it by sticking up the discount rate. We'll actually do it by chopping the cash flows on the top. And so I think that if you were going to do the standard route of saying, okay, let's use the CAPM approach, you can't get to those sorts of numbers, because what's the current risk-free rate? Well, if currently governments are borrowing it close to zero in nominal terms, not just in real terms, in nominal terms. But let's even assume normal situations. Maybe you'd have, I don't know, 5%, 7% nominal interest rate in recent years. I don't know what you were told was the equity risk premium by your professors. I don't even know who your professors were for business finance. I could then probably infer it. But who was, somebody put in chat, who taught you business finance? Then I'll try to predict what their market risk premium was. Oh, Shapiro. Oh, the dragon. Is that what you call Shapiro? That's that's good. So I predict Shapiro said 5 to 7. Am I right or not?
Yeah, very likely.
Yeah, that sounds about right, because he's quite traditional Shapiro. He's sort of, that's what many textbooks tell you. I think that's a bit high myself. I'm more of a 4 guy myself in terms of the market risk premium, but we'll go with Joel. And so therefore, you know, if you're going to use like a market risk premium of about 4% or something like that, then you're thinking, well, what's the systemic risk of this business? Well, then you get into real issues, because many of the risks of startup businesses are not correlated with the stock market. They're basically correlated with whether you succeed or not, whether your model gets adopted by, you know, lots of people, whether you beat your competition. Of course, the stock market comes into it sometime, you know, in some respects. If the economy takes a dive and you know, that's not good for business. So it's not like there'll be a zero beta, but many of the risks are idiosyncratic, not actually systemic. So in a sense, in a portfolio, if you invested in hundreds of these startup businesses, then all those risks would sort of go away. Some ways you can think of, like, that's what SoftBank do. They invest in virtually all the ride-sharing apps. They invest in Uber, in Ola, and all these ones. One of them will come right, probably. So they'll make money on one of them, but they don't necessarily care about which one it is. They'll come right on one of them. So, you know, I think it's tempting to think that they have very high betas, but I don't think they do. But Sifa, you've got your hand raised, so
thanks, Tim. Yeah, I was just actually gonna, on that point, get your thoughts on the idea of a country risk premium. You know, I'm based in Africa, and in my previous business, we eventually raised some capital from US-based investors and South African investors, and now I'm working with kind of startups, and it almost feels like investors always use the idea of a country risk premium as a way of getting around, you know, giving a decent valuation. So that's the one hand. And then on the other hand is, if you're going to chop the cash flows, on what basis, you know, do you chop them, right? Because the entrepreneurs know their business probably better than the investors. So just really keen to understand how that would actually work, you know, cutting the revenue line versus the discount rate.
Yeah, I mean, okay, so the country risk premium, yeah, they're very often used by, especially by international investors, because obviously within a country there might be, you know, there's obviously a risk. There might be more of a risk investing in one country than another, but often that's actually picked up by, to some extent, by the if the risk is associated with things like inflation might be high, and that might mean that the exchange rate will fall, for example, and you as an international investor care about that. That will to some extent be there in the in your inflation estimate, I think. So if you but having said that, you know, so high inflation countries tend to have high interest rates, and that will affect to some extent the inflation risk associated with a country. But then there are also the risks of expropriation, of things like that. And so there are international indicators of country risk, which you can actually use. So there's Damodoran, for example, has on his website some of those sorts of country risk premia that are quite commonly there. And it is, Brendan says, is it more political risk for foreign investment? There is an element of that, because there is this fear of expropriation. There's also the fear, as I say, I think it breaks down into expropriation risk, or sort of possibility that taxes might change or something, which means you can't get your money out. And then there's inflation risk, and like that is, or inflation stroke collapse of the exchange rate risk. And those two are very highly correlated, and those are both tend to be there, one in the nominal interest rate, and the other one in some country risk premium that you might apply, in particular to the, could be both to the equity and the debt. You might fear that you couldn't get your money out at some point in time. So there are ways of doing that. Does that answer the question on the country risk premium?
It does, thanks. Yeah, that's helpful. I suppose I'm just interested in the alternative approach of, you know, looking at the cash flows, because I do feel that it's kind of it gives the investor an unfair advantage. You know, it's just like, yeah.
What I'm going to do is park that one till afterwards, because when we get to the scenario DCF, I'll go through that. So we'll look at that explicitly. Okay. So so I think for the time being, if you were thinking about it in pure sort of CAPM terms, you know, what might you do? Well, you might come up with some sort of cost of equity of about 12% or something. You can't get much higher than that, because even if you had a 5% interest rate in nominal terms, you had a beta of, I don't know, 1.5, and you put in a risk premium of, I don't know, 6 or something like that, you know, you're not going to get much above about a 12% discount rate with current interest rates, with inflation being so low, because basically that's almost like a 12% real return, which you don't normally get on heavily diversified, you know, portfolios of equities. Now that's allowing for a slightly higher beta, but it's hard to, I don't think I've ever seen anything with an asset beta of more than 2. And so that's actually pretty high. You can't get much beyond that, in other words. And I see some of Imani, I think you got pretty close to that, or maybe even have got it. So, yeah, I think that you don't get much beyond that, which is one of the problems, because you say, would you invest in this business with a 12% discount rate? Certain probably not. But if you did, these are the sorts of, you know, you would then have to discount these free cash flows at a 12% discount rate. You need also a terminal value, because you've only got 5 years of cash flows there. And so what I might do at this stage is, because I don't want to eat into breaks too much, I think I'm going to let you remind yourselves about how you worked out a terminal value, and then we'll come back after the break and we'll just finish off the DCF stuff, and then go into the remainder of the session. So so why don't we take a break at this point, come back at 1/2 the hour, and I'll finish this bit and then take any other questions that you've got about this. As I say, this is the old way of doing it, if you like, the basic. I'm going to make the bridge between business finance, which is where we are at the moment, into the more entrepreneurial side after the break. Okay, so so we'll stop at that stage, and as I say, I'll keep the room open if anybody wants to chat with each other, but I'll go off video and on mute as well. I'll see you in at 1/2 the hour, where we're getting to. But in terms of the, let's remove this. Here we go. So where we'd got to was we'd sort of established our, if you're doing a standard DCF approach, you've got your discount rate, you've got your free cash flows, and then you've also got, you need to have a terminal value, because you've only got 6 years of cash flows here, so you're going to need to make some assumption about what happens in the longer term. And you may remember there's 2 ways to calculate a terminal value. Again, this is stuff you should have done before, I'm sure. You can assume a perpetual growth rate, which happens beyond the forecast period. So, you know, it's almost like saying after 2017, the growth rate will be 5%, 2%, 3%, whatever. Or there's another route, which is you use a value of the terminal of the final year forecast. So in other words, you say, in 2017, what would a company be worth if it did have those characteristics? In other words, it's got free cash flow of 1760, and you've got all the other aspects to it. And I'm not going to talk about that now, because that's actually very similar to the VC method. I want you to bear that in mind. What the VC method does sort of looks at the terminal value quite closely, and so we'll come back to that a little bit later on. For the time being, the sort of standard way of doing a DCF is to stick in some terminal growth rate assumption. Okay, so if you do all that, and you work out, and you've got the formula, if you remember the formula for how you work out the terminal value, it's your forecast cash flows in 2017, the 1760, times 1 plus the growth rate over the discount rate minus the growth rate. So if you put in a growth rate of 5%, for example, then you can work out the terminal value very straightforwardly, because the terminal value in that case is going to be 26 million. And what you then do is you add up the cash flows and the terminal value, and you discount it back to the present day. But one thing to note here, and this is true of virtually all early stage ventures, and is one of the problems of using a DCF, is basically all the values in the terminal value, right? So if you look here, the cash flows up until the final year are sort of negative and then positive, but they're barely any more than the terminal value. And so it's absolutely critical what assumptions you make for the terminal value here. So that's one of the reasons why, and it's very difficult to know whether you should use like a 5% growth rate or a lower growth rate or whatever. So this is one of the reasons why it's very, very hard to use standard DCF on an entrepreneurial venture, because basically you don't know what the input is. It's a perfectly valid procedure. I don't want to suggest that Shapiro didn't teach you something that was worthwhile, but it's very worthwhile for established businesses which have pretty predictable cash flows, and those are things which we don't have in the case of a startup business. But if you believed all that and you did it the standard route, you'd say this company could be worth 13 million, because if you discount those cash flows back to the present day, if you do it, I'll make this spreadsheet available, but basically those cash flows discount back to an NPV of 13.8 million. Okay. Now, does that sound reasonable? Well, not necessarily. You could think of, well, you might well say, well, what about other assumptions about some of these factors? You know, is 5% realistic? 5% forever is actually a very high growth rate. But for many startup businesses, a 5% growth rate for years 6, 7, 8 is not very high. And so it's quite hard to use the standard sort of approach of saying, you know, that it's going to be 5% constant forever. Just doesn't feel right. But you could say, well, maybe 5% is too high because it'll grow into an enormous company. What about 2% or whatever other percentage you want? So you can sort of you can put in any numbers you want, but what you'll find is that the valuation goes all over the place. So if you put in a 2% growth rate into the terminal value, then the value falls from 13.8 to 9.5 million. So a pretty big effect, as you'd sort of expect, and it's very, very hard to work out which of those is more reasonable, or indeed whether a constant growth rate is even reasonable at all. You know, there's a bunch of different problems with that, and that's why in practice, you know, what venture capitalists tend to do is not the standard DCF, but actually start thinking about, well, what you're really worried about here is what happens if things go wrong, and what happens if the entrepreneur is being too optimistic. And so there's generally, I think, a view that entrepreneurs are too optimistic about revenues. And this goes back to the question I was asked a bit earlier. And so, you know, it's often the case that, for example, that people think it'll take twice as long to get to the revenue that you project. So, you know, you have a projection, you're going to hit a particular revenue in 2 years. You know, history tells you that it often takes 4 years to get there. Or equally, you could say, well, it's actually, the revenues tend to be overestimated by, I don't know, 50%, or the cash flows overestimated by 50%, is pretty typical. So it's not that you necessarily say it's definitely going to happen, but you might say there's a whole bunch of different scenarios here which are perfectly possible, including a complete bust. And so what I've done in this chart, in this sort of little table here, is say, well, what would happen if you thought about what the scenarios were on the cash flows? We're not mucking around with the discount rate here. We're actually just thinking, what are the possible scenarios for the cash flows? So you're doing the top line, the numerator, not the denominator. And so here I've just come up with some possible views on that, and don't take this as gospel, by the way. You know, all I'm saying here is these are some possible scenarios that you might think of. So you might say, well, you know, there's a 20% chance that you'll get the base rate cash flows and a 5% growth rate. So, you know, that's, if you like, the optimistic management case, if you like. You might say, okay, well, I believe the cash flow forecast, but I think the growth rate will be slower in the longer term. You may 20% chance of that. Or you could say, well, I think they're only going to get 50% of the cash flows and then 5% growth after that point. So you might say they're being too optimistic. You could put it with a lower growth rate, or you could say, from my experience, 40% of all deals, you know, never work out. They're a complete bust. So I'm going to put in that I'm going to lose, you know, this thing isn't going to succeed with a 40% probability. Okay. Now, as I say, since this is sort of relevant for the assignment, these are not like, they're not coming from heaven. They're not like, you know, written on tablets of stone. I'm just using this as an example of the sort of way you could go about it. And I think a lot of times venture capitalists or angel investors will be thinking in these terms. They'll say, okay, I see the cash flows, but, you know, I'm thinking in my mind that there could be some worse outcomes than the one the management's saying. And so if you take that sort of approach to it, then you can basically weight those. This is why it's called a scenario DCF, based upon these sort of subjective probabilities. And you could say, well, the valuations of this company range from 13.8 in the good outcome, the management base case, 13.8 million, down to 0 if the whole thing is crashes and burns. We don't know what that's likely to be to begin with, but these are my probabilities, and I get to 5.8 million. And that's much closer to the sort of Series A type valuations you get. If you remember from yesterday, it's normally single-digit millions of dollars. And so this sort of scenario DCF brings in this subjectivity about probabilities, but is, I think, very often the way people are actually thinking as investors in these businesses, is they're thinking, you know, okay, I sort of, you know, I want to believe the management case, but there's only a half probability or something that will actually occur. Let me just stop at this point and just see if there's any questions anyone's got about the sort of way in which you can adapt the sort of standard route to make it a bit more realistic when you've got a high degree of uncertainty about the probable cash flows. Any questions about that?
Tim, just one. Yeah. I've seen VCs do a case where, especially technology companies, they've got a benchmark of different technology companies in a particular sector, and they'll say, based off these particular companies that you're competing against, this is, you know, the range of values. Mm-hmm. So they might do this, but they'll still have that range in terms of other bids that have actually happened. Is that also your experience?
It is, and that's actually the VC method that we'll be coming on to in a second. Here, you'll notice we haven't got any comparators in here. With the reason for that is that there's obviously a problem with comparators, is you've got to believe that the comparators are accurate, right? So there can be this sort of self-fulfilling hypothesis that, you know, okay, Uber's valued at 75 billion, so therefore Ola must be valued at 50 billion, and you know, all these things. And so there is this problem that there can be the sort of madness of crowds, that, you know, everybody sort of believes that it's right because something else is right. And DCF is at least fundamental insofar as it's saying the value of something is ultimately cash generation, which is why we spend so much time on it in business school or in economics and finance. And so it is a different method, and it's very heavily used. So in fact, you know, I think we'll come on to that in a minute, because it's probably the dominant method is to price off other similar companies. So hold that thought, and we'll come back to it. I see we've got Nick as well. You had a question.
So I just wanted to two related questions. One is that, you know, you're basing this theoretically off your management projections.
Yeah.
And obviously there's a bit of a dance that goes on that, you know, that management have to project something quite punchy to, you know, incite the interest of the VCs. And related to that, that's driven by at least as I hear it, you know, the VC portfolio being made on the back of the, you know, the one really big 100x success.
Yeah.
And so that's what is driving the decision making. So how does this kind of reconcile to those two things, which really probably pull away from reality in terms of projections?
Yeah, no, it's a good question. So it's certainly true that VCs won't invest in stuff unless they think there's a chance that you'll hit it out of the park. We've had a lot of VCs talk on our course over the years, and in fact, I often ask them the question, what are your investment criteria for investing in a deal? And I've had some amazing answers. One answer I got was, the deal has to have the potential to return the whole fund. Now that's an amazing criteria. So think what that means. It means that if you've got 100 million fund and you're putting 5 million into this deal, it has to have the potential that turn that 5 million into 100 million. That's what it's really saying. And they said it with a straight face. And I think that that's because there has to be at least, they have to have some vision that if everything went according to plan, it could do that. And that makes it exciting as a sort of, you know, to overcome the likelihood it will actually fail. So I think you're right. As an entrepreneur, you do have to have, if you're going to go out and bid for venture capital money, you do have to have some projection which is potentially yielding many multiples of the money for the investors coming in. It can't be something which, you know, if with a following wind you make 3 times your money. That just will never succeed. 3 times your money is actually good money, but if that's your best projection, it probably won't succeed. And so I think what the VCs do is they want to check your unit economics and the sort of the business and why it might succeed. And so, you know, is this something which has got very low marginal costs if it succeeds? And if it really did, then you could turn into really big margins. Is it something where it doesn't scale so well? So, you know, it's hard to necessarily see how that would generate many times your money return. And they don't necessarily tell you that they don't believe your projections, but they might just shave the value in this sort of way. So they say, sure, we'll go with your base rate scenarios. We're going to hold you accountable to those as well. But actually, even with those, we only think it's worth £6 million. And you might then say, but look at my DCF. You know, it's worth £50 million or 13 million, 20 million pounds on my DCF. And they'll just say to you, it's not, you know, that's not my experience. You know, for various reasons, I think it's only worth single digits, millions, which is what the answer always seems to be. So I think you definitely have to excite their interest, but you shouldn't put in things which are so crazy that you don't believe them, because you will be held to account for them. They will come along and say, oh, you put in your business plan that, you know, you were going to achieve, you know, cash flow positivity after 6 months. Well, if you genuinely don't think you can do that, don't put it in. And actually most VCs don't really care about that. What they care about is making money at the end. So put in something which is realistic is my advice. Sounds like you've done it recently. So have you? How did you overcome this problem of convincing them to, or interesting them, but not wanting to over-egg it?
Well, I think we didn't. We tried to be, well, we had to play the dance slightly, because, you know, you have to show the opportunity, but obviously we're only doing it because we believe there's some, you know, big opportunity. I think actually, you know, the people that we've got, the angels, you know, are pretty experienced and, you know, are pretty realistic and are actually not interested, you know, in, to be honest, the slide in the deck about the projections was like, yeah, just don't, you know, yeah, you've got it there. We kind of, you've made a slide to sort of show what it could be, but we basically discounted it completely from our analysis. We're not interested. We're not investing on the basis of that.
Yeah.
At this stage, anyhow, we're super early.
Yeah, In the early stage, it is much more done. I mean, you don't necessarily even talk much about valuation. You sort of talk about, I need 50,000, 100,000 to get to the next stage, and you know, will you help me get there? Is sort of the discourse. This becomes more important when you get to the sort of first, when you're talking about, you know, getting $1 million or $2 million in terms of, you know, investment. Then people do tend to do that. But I think it is one of those things which is, it can be frustrating to many people because they think, oh yeah, I'm going to spend an enormous amount of time doing this, like, you know, valuation slide. But actually VCs work on a slightly different way of thinking about it, which is a bit like these scenarios that they're forming subjective probabilities about. But often they won't articulate them. They'll just say, look, from my past experience, I think this company, you know, and looking at other deals I'm doing, this feels like a $5, $6, $7 million dollar valuation. And it can be a bit frustrating, but I'm giving you some sort of, as it were, ex post rationalization for why they seem to come up with these sorts of numbers, I think. Other questions? Laurent, you've got a question.
Yeah, I was wondering whether you, on top of your valuation, there was an adjustment to it. You would also consider some liquidity risk, because all you have established so far is an intrinsic valuation based on cash flows, but there is not necessarily a market out there for exit. You know, it's not like you have a listed investment and
Yeah.
you've got a stock market to buy you out. So I was wondering whether there should be further adjustment to that number.
In principle, you're exactly right. This is not comparable. You know, in a sense, a beta coefficient doesn't account for liquidity risk, right? It accounts for systemic risk. So you could certainly add on a few more percentage points onto your discount rate for liquidity risk. It makes perfect sense. I think that in practice, you know, the discount rates that people will use could be a bit higher than 12, but they're often not very well articulated. But in principle, I think you're right. And indeed, I'll be coming on to, when we talk about the VC method, I'll sort of use that as one justification for why the discount rates that are used in the VC method are so high. So hold that thought. It's a perfectly valid. And I think that's definitely what some people think about.
What I've seen with the IB, when they invest in ventures like this, they would come up with a number you've got there, and they would take out 20% for liquidity.
Right.
That would be the discount applying there too.
Yeah, and in my experience, I've seen that as well. And in my experience, I'm never quite sure whether it's just a final haircut that they do to you know, which is not exactly based upon science, but it's just, okay, whatever the answer is, we're going, you know, using some sort of quasi-scientific method, then we're going to slice 20% off because, and they'll say liquidity, or they'll say, oh, tail risk, or something like that. People give different reasons for it. It's very frustrating to deal with as an entrepreneur. But my strong advice would be, don't get too don't feel as though the most important thing you're ever going to do is argue about a valuation. You know, if you remember what Carol said yesterday, he said they were often negotiating the valuation down, you know, because what they wanted to do was to have happy investors, to have rounds where the price kept going up, so everybody was happy. They never ended up with any complexities which come about, as we'll see tomorrow, when you have down rounds where the price goes down and various things in the term sheet kick in. And in some respects, you know, the price is important because it affects dilution, but within a range, you know, if you give up 10 to 15%, you know, around, that's sort of expected. And all it really affects, you know, you do want, your life is much easier if your value is not too high, so that the next round they come along and say, okay, well, you know, we think you over-egged it on the first round, and we, you know, you've got a too high valuation, it will come in, but it's lower. That's not a good place to be. So
one more comment on the discount rate. I mean, as you explained, I mean, the company at first round is worth whatever it's getting paid for, and whatever the methodology is applying there, and then you could do whatever you can to justify the price. But from that very price onward, you've got some metrics, because you're supposed at that stage to establish an IRR for your investment. And that's a future guideline for what's going to happen next. And that's an important milestone that you're going to be using going forward.
Yeah, no, certainly from the investor perspective, it does matter, because you're putting in good money at this point. So the investor does care, and they do, and they will want to not have to write down their investment, which is very bad for their IRRs, obviously, and things like that. So investors will want to invest, at a reasonable valuation, so they get a decent IRR. Remember also that, and we will see this, later on, but they typically use, quite big haircuts here to the cash flows, or maybe put in very high discount rates in a VC method setting. But remember the returns, like the returns were for a decade really low, even though they were using these discount rates. So then that is telling you something, that the returns have not been super attractive. The last 10 years they have actually for venture, but before that the returns were not super attractive, even when they were doing all these haircuts. And that's ultimately quite important, because that affects the flow of capital, because it affects the IRRs and the money multiples. So it's pretty important. It's not, so investors will argue down the initial valuation. And I suppose what I'm saying is, don't feel don't feel as though your objective is to maximize the initial valuation. If you do really well, you'll become rich, even if you set a sort of normal valuation, single digit millions. You'll still do very well out of it if you are successful. It's not like valuation is a multi-stage game, and it doesn't make sense to maximize it at the first point necessarily. So anyway, let me just head on a little bit, because actually no, sorry, Sifa, you had your hand up as well. I'll take yours now, then I'll go on to the next blog.
Thanks, Tim. I was going to ask, what are your thoughts on clawback mechanisms, equity clawback mechanisms? And some of the term sheets I've seen recently, the investors will build that in as a way of mitigating the forecasting risk. So have you seen that as a common practice? What are your thoughts on that?
Yeah, so the clawbacks can go both ways, actually. They can go that if that the investors can get more equity if you don't hit certain milestones, and equally you can incentivize the management and say, okay, we're going to let you get, we'll give you more equity back if you hit certain milestones. And funnily enough, in the case of Verivox, the business I was involved with, we had one of the latter, which was built on exit. So they said, if you exit within a certain period of time, we'll give you some additional equity as a result of that, to give you an incentive. They're used, I would say, like in Silicon Valley, they're not really used at all. In the US framework, you don't tend to see clawbacks, but you do see it in some other countries. You occasionally see it in the UK or in Europe. I've seen it. I think they can be perfectly legitimate. You can see why they're there. They're sort of saying, I don't quite believe your forecast, but if you're right, then I'll give it you as a sort of implicit higher value later on. In a way, if that is the scenario we're dealing with, that I'm going to give you a low value now, but you'll get a high value later. In a way, you're going to benefit from it anyway, right? Because you're going to actually sell equity at a higher value. So I think it's not necessary, but lawyers will come up with any number of new innovations here. One of the things in Silicon Valley is things are very standardized, and there's not really negotiation over these things. People talk about a clean term sheet, which is basically completely standard terms, which you'll see on tomorrow, what standard terms look like. And you don't actually see clawbacks in standard terms. Nothing wrong with them in principle, though, I think.
Okay, great. Thank you.
Okay, so let's just head on a little bit. So, one of the issues, so in a sense, one of the problems with cash flow based models where you're doing like DCF is that you've got a lot of uncertainty about revenues, about sales. You often find that things aren't at all linear. Things can go slowly for a while and suddenly take off exponentially. You've also got the fact that you've got like cash flows negative for a long period of time. And so you know, and while you're doing that, there's all sorts of optionality happening that you may say, oh, actually, I don't think this is going to work anyway. I'm going to do something completely different. So it's very hard to sort of forecast those cash flows. And in most entrepreneurial ventures, given that you've got the forecasts involve a lot of negative cash flows to begin with, most of the values in the terminal value anyway. And so, you know, it's sort of, and then you get into the whole business about how do you forecast the terminal value. And that's in a way where the sort of idea behind, you know, behind the VC method, as I'll come in a minute. The problem with terminal values is they're highly sensitive to both the terminal cash flow. So, you know, you had to believe in that 2017 cash flow forecast and the growth rate assumption. So, you know, those are a couple of problems. And it's quite difficult sometimes if you want to take another route and say, well, what's the growth rate of comparable firms? It's often quite difficult to find comparable firms for, you know, very innovative new ventures where they're sort of category defining businesses. You know, at the time that Facebook launched, what was the expected growth rate of competitors in the social networking space? You know, you didn't really have any. So it can be difficult. It can be difficult to do. So those are some of the reasons why you don't generally see the DCFs being used that much. When you do, it's normally in the sort of scenario DCF where you're allowing for different sort of cash flow outcomes and using a sort of reasonable discount rate between 10 and 20% to discount those, so you're not putting huge amounts of dealing with risk in the discount factor so much. You're more dealing with risk in the top line cash flows. Okay, so that's the DCF type approaches. What I'm going to do for the rest of the session is talk about a very different approach. It's called the venture capital method, which, as you'll sense, is only really used in this area. And as as a sort of card-carrying academic, there are some aspects of this where I wave my hands and I can't quite justify it by, you know, by finance or economic theory, whereas DCF is very beautiful and the CAPM is very beautiful. There will be bits of this that I can't justify, but they are just market practice. And the way that the VC method works is it's got basically 4 steps. Firstly, you sort of define what a success scenario is. So you sort of look to the future and say, if this is successful, what would success look like? So you might look to like year 6 and say, okay, that's the success outcome. What would the company be worth at that point? Okay, so you then might say, well, what it might be worth is by looking at comparable companies that are doing similar things. So it's not looking at terminal growth rates. It's basically trying to say, what are the sort of metrics which would tell you the value of a company that had similar characteristics, not the same, because you very often can't find complete comparators, but similar characteristics at that point in the future. Then you sort of say, how much equity financing will it take to get to that point? Okay, so how much dilution will there be to get to that point in the future? And then essentially you say, so given all those factors, how much of the pie do I have to own now in order to get a decent return in the in that sort of success outcome? Okay, and so what I'm going to do is just step you through what's going on here, and it's not too complicated. There's just a few. It's basically sort of ignoring the intermediate cash flows in some respects and just saying what, and it's sort of saying I'm going to focus on the successful outcome, but I'm going to discount the hell out of that. In other words, say I'm going to focus on the success one, but I'm going to use a very hefty discount rate to take account of the fact that I may well lose all my money. So it's like doing the opposite of what I was saying with the DCF, where I said, when I think Nick asked me the question, you know, or said 50%, he was thinking in VC method case. I was saying, if you're going to do a DCF, you should sort of put the risk into the cash flows and keep the discount rate clean. Here they're doing the opposite. They're basically saying, we're not really going to look too much at the cash flows in the short term, just going to look at what it might be worth if it's successful, but we're going to put all the risk in the discount factor. Okay, so that's what I'll lead you through. So the first thing is, you sort of, you know, you as a venture capitalist, you sort of look at the cash flow forecast, you see whether you think that they're realistic, and you come to your own view about whether or what you think success would look like for this business, which could be what the entrepreneurs say, it could be higher, it could be lower. For the purposes of this, what we're going to do the rest using the Vino Veritas case, I'm just going to assume that the VCs looked at it and says, yes, the forecasts are reasonable, that's a reasonable success scenario, just so that we can continue the analogy through the case. Okay, and so the second thing is to say, well, what would that company be worth at a point in the future where you're, if you know, in 6 years' time, if it was successful, how much would it be worth? And here you get into some of the real art of this, because you're saying, okay, well, what is comparable to that company? And I spend quite a lot of my time, you know, when I'm not doing academic stuff, doing valuation often for litigation cases, sometimes actually in fair value cases and things like that. And so I spend my whole time trying to come up with these sorts of analogies as to what's a sort of similar company. And you do look at things like, do they operate in similar markets? Are the growth rates similar? Is the asset intensity similar? So how much capital will it take to get there? What are the cash flow characteristics of the business? And it's funny, you end up having to be very creative about it, because very often you just don't have a comparator. I'll give you a funny example, which isn't really in the entrepreneurial business case, but I was involved in some of the litigation over Formula One, which the racing championship, which, as many of you will know, was actually owned by a private equity firm, CVC. And when they bought it off before they owned it, they bought it off a German bank, which had owned it because they got it went into bankruptcy. And there was a litigation associated with that, because the previous head of Formula One, Bernie Ecclestone, had bribed one of the bank employees to sort of be on his side. And this guy ended up in jail. So this is all in the public domain. But there was a litigation about how much was Formula One worth in 2005. And I was the expert valuation, sort of the valuation expert who had to opine on that. Now, the problem is there isn't another Formula One. So what do? So why don't we go through a little exercise here? It's not a startup business, but many of you will know what Formula One is. Anybody got any ideas in chat as to a comparator firm that you might use to value Formula One? So here's your chance to be creative here. NASCAR, nice idea, not publicly owned. Would have loved it if it was, but not a publicly owned company. So keep going. Manchester United, thought of that. Problem is so it's a sports franchise. It gets a lot of its money through TV revenues, which is the same as Formula One, but it owns a lot more assets. So Formula One actually owns no asset, doesn't own a stadium or anything like that. But yeah, listed football clubs were one thing that we did look at, and Manchester United is listed, so you can use that. FIFA's not listed, so it would be nice, but not there. World Rally Championship. There was one other publicly listed championship, which was actually motorcycling, which we did look at, but unfortunately it had been bought by another private equity fund, so we couldn't, at the time, we couldn't actually use those. But thinking all the US, anyone in the US, there's a very interesting, or there's our closest analogy was a sporting event in the US. Yeah, wrestling. Somebody's got it here. There's a world wrestling. I actually forget what it was called, but there's a franchise, world wrestling franchise, which doesn't own any like the arenas or anything, but it basically is TV rights and things like that. And we did use this. What's it called? Ultimate Fighting something. It's publicly listed. UFC. That's it. Ultimate Fighting Championship or whatever it's called. That was what we thought was the closest comparator to Formula One, because their revenue streams were similar. In terms of it was mostly getting paid by TV rights, by the arenas for holding the events, because Formula One, interestingly, it gets paid by many of the arenas, at least the new ones. The old ones, like the old European arenas, don't generally pay. There are some who don't pay, but the new ones do. Like if they go to Bahrain or Abu Dhabi, they pay good money for it. And in UFC, some of the arenas pay as well. And they also got money from corporate hospitality, selling boxes. So we used UFC as so wrestling was the best comparator to Formula One, is what we thought. Now, that's a sort of silly example, but it shows you what you have to think about. Just think, how's it matching on all these different criteria? And we did use some of the others as well, like Man United. So you've done rather well here. This is better. You got there very quickly. But thinking about, if you're thinking about comparators, you have to think quite creatively and match it on things like the things on the screen, either, the physical characteristics, how much capex they have, or things like, whether they're in a similar cyclical market or the like. And then what you've got to do is say, well, what ratios are we going to use to value this? Because you might say, okay, we're going to use UFC, Ultimate Fighting Championship, but are we going to use their, the amount of revenues, EBITDA, it could be for other types of business, like which are more subscriber based, like a lot of software businesses. You do it value per subscriber, or average revenue per user, things like that. Again, you can value things in various ways. It's the most creative part that you have to sort of deal with when you're going down this route of thinking what a new business will be worth in the future. So that's not to be trivialized. This is quite hard, but if you do that, you could think, okay, so what would it be worth? The thought process is, you've got a company that 6 years out has got 7 million of revenue, 3.3 million of earnings, 7 million of assets on its books. What might it be worth? And so you might look for some comparators in the same market, and you might look at one of these sort of accounting measures, and you've got to be pretty sure that the accounting numbers sort of stack up, because when you're looking for a comparator, you've got to make sure that it doesn't have there's not some weird thing going on, like there was some particularly large acquisition in that year, or some, they hadn't got some exceptional items or something like that. So you need to be careful there as to what the accounting numbers say, but you take some observable accounting ratio, look at the numbers for the comparator, and just work out what that implies for the value of your company. And so most of the time that you use financial ratios, but some of the time, in some days, you do see people using actually physical indicators like, clicks, customers, it used to be web page impressions. I haven't seen that used for a while, but generally you're using these sort of financial ratios. So if you were thinking about that, that will get you the value. And we'll work through an example in a second, but then you've got to think, well, how much will it take me to get there? So we're saying 6 years time, it could be worth whatever, 50 million, but how much will it take to get there? How much dilution will there be? Because what you're concerned about is there might be a 50 million cake there, but lots of people are going to be nibbling away at that cake. The founders, the employees, the new people who are coming in and providing capital. So how much dilutions they're going to be along the route. Okay, so that's the next stage you've got to think about. The third stage is think very carefully about how much capital it takes to get to this sort of fine position at the end. And then you think the fourth step is, well, given all that, what sort of rate of return should I expect? Or should I, put into my early stage investment, and in terms of what is my experience that the rate of discount I have to use in order to get decent returns out of this. And in a way, what you can do is think about this as building up a sort of returns from the least risky to the sort of, you know, to other factors. Like you start with maybe, you know, a risk-free rate, then you think, okay, there's a premium for market risk, if you like, equity risk premium time beta, then there's a premium for illiquidity, as was mentioned earlier. You might then say, well, you know, okay, if this was normally distributed, I wouldn't have to do too many of these and I would get, you know, the right rate of return. But if you've got non-normality and you know, you've got lots of zeros and very few very high returns, you might want a premium for the fact that you're, you know, the law of large numbers takes a long time to work here and average out your returns. So you might need a premium for that. And you might also say, well, look, I've got 50 different, you know, business plans sitting on my desk. I'm going to I can add value to you, and my time is valuable. So therefore, you know, that doesn't come for free. So you might say there should be some premium for, you know, the value added sort of services that I could provide as an investor. So at this stage, my hands are going to start waving because I'm going to find it very hard to justify the discount rates that you see on the next screen. But what tends to happen is you think that varies according to the stage of investment. It'll be higher for very early stage ventures, and towards the end, it's maybe much less, because actually by the Series G or the like, you sort of pretty much know what the outcomes are going to be. They're going to be more normally distributed. You may not be adding so much value. It may not even be that illiquid, because it might be that they're going to plan to go public or sell in the next couple of years. So you don't necessarily need such high returns. But these are the sorts of numbers that you see being bandied around in the industry for discount rates when you use this sort of VC method. And remember here, one of the reasons why these are so high is that you're not actually taking account of all those negative cash flows, except that they influence how much capital you've got to raise. It's really just focusing on the final sort of cash flow and saying, what does a successful business actually look like? But as you can see, they are, you know, only down towards the bottom do we go into the DCF range, if you like, the public equity expectations, you know, 10 to 15%, which is where you'd get from a standard DCF. You're really saying, okay, for a seed stage, you might want an 80% discount. You might discount those sorts of future returns by 80%, and for Series A, you may be 50 to 70%, or, you know, your second stage, you might be down to 30 to 50%. You know, that's the sort of ranges that you see being used in practice when people are using this sort of approach. It's very hard to justify in terms of theory, but it's almost like a heuristic that if you use these sorts of discount rates, the returns sort of come out okay in the end. It's a bit like what Alan said yesterday, that, you know, that there are a whole bunch of rules, like, you know, if you have a 20% carried interest, or if you have a 6% hurdle, or you use a 50% discount rate, then over time people have realized that you need to operate to, you know, that enables you to make high enough returns in order to raise your next fund. Okay, so if you do that in this sort of case, go through this little example. So imagine that there are the financials in this, as it's in the case. You have one round of equity invested 1 million at the start of 2012, and that you plan to exit at the end of year 6. Okay, and you think that it's going to have a PE of 10. I'm going to give you 5 minutes in study groups to think of what stake you would need in order to earn your, say you thought you needed a 60% IRR. Okay, so this isn't a hard calculation, but it's worth going through. So think about what stake you'd need you'd need to have in the first round if you're a VC fund with that approach, right? So I'll put you into study. Hopefully you've all got the terms there. So 1 million the cash flows in the case, you're investing for 6 years, PE of 10 on exit, you want a 60% IRR. Okay, so what I'm going to do is put you into study groups for 5 minutes and see if you can come up with the right answers. So I'll put you into, let's see, 6 study groups. 5 minutes, go forth and do your calculation. Just open the rooms. There you go. Start the recording here. So you'll see I put into chat what proportion of the equity you thought you should ask for if you believe those financials and you're using the VC method. So anybody got a number? Then we'll see if you're on the, okay, 16 on bid from Brendan. Anyone else? Any others? 50.5 from Steve. That's a bit different. Any others? Which are not, any people who are not in those 2 groups? I assume you weren't in the same group. But, any other numbers anyone's prepared to admit to? Okay, so Steve, tell us how you got your number, since it's right. So, so just lead us through that.
So I started by working out what the future value was. So you gave us a price earnings ratio of 10, and the net earnings in 2017 were 3.3 million. So that means price earnings of 10, that means the valuation is 10 times the earnings. That gave me the future value of the company of 33.25 million.
Yeah.
And then I just discounted that back by 6 years using the discount factor of 60%, which was the IRR that you'd given us.
Yeah.
That gave me a value of, a present value of 1.98 million. And I just divided that by the 1 million that you wanted to invest, and I got 50.5%.
Yeah. Anybody got any questions for Steve on that calculation? It shows you that it's a brutal thing to use a 60% discount rate for 60 years, right? 6 years. If you're using that sort of discount rate, you're going to need to have a huge sort of proportion of the pie just to get to the point where you're earning 60% a year for 6 years is a very difficult, very demanding. And of course, there are various ways you can avoid this. Right? Because you could say, well, what I'm going to do is actually make an initial investment of maybe $500,000. That's very high risk. Maybe I need 60% for that. But if that'll get us through 2 years, and then maybe in 2 years' time, I'll put in another $500,000, and for that I'll need 40%. And so if you did that, you already know what the answer is, at least for the first one. If you put in $500,000, you'd only need 25% of the company, and that's getting a bit more normal. You would almost never be able to, it wouldn't make any sense to do this deal, because 50% of the company to the first round investor is just way too much, right? So this is telling you one of 2 things. Either it's just not a very valuable company that's not actually going to attract venture capital financing. So maybe 3 million of earnings in 6 years' time is just not exciting enough. given the amount of capital you've got to put in. Or it's telling you, well, you should stage this and you know, put in a bit of money to begin with, see how it goes, and then, you know, and then decide what to do later, which is often the way it works, that, you know, you sort of put in small amounts of money, and if it succeeds, then you sort of double down on it. Any questions about that sort of general approach? It might feel a bit weird because you're sort of solving for the ownership stake here, which might feel odd, but that's basically the thing you negotiate over in an early stage venture, is how much of the company you're giving up. But if anyone's got any questions about this, just raise your hand or chip in at this point, and because we're going to work through an example of a 2-stage financing round now. We're going to sort of extend it one more round, just to give you that practice, and also because there's a slight complexity here, which maybe some of you will find. Okay. All right. Well, let me set that up. In terms of, so let's go back to the presentation for a second. So in our example, which is exactly the way Steve explained it, you sort of put in your forecast earnings in 2017, multiply it by the PE, and then use a discount factor of 60%. So in other words, 1.6 to the power of 6 will give you the number of 16. You need to get 16.7 times your money back in order to get a 60% IRR. And that's, I want to stress that this is sort of, this wouldn't work. So this isn't the way you would do it. You'd have to chop it down at this stage in terms of, you'd have to think in a different way. But let's just go on one more round. And this is going to become even more, in a sense, even less likely that you would do the deal. But let's imagine, because if you remember, one of the stages in the VC method is to work out how much capital you've got to, how much equity you're going to give away in order to get to that good outcome. Okay, that's the sort of mindset you're in. What's the good outcome look like? How much would the company be worth at that point? How much equity will it take to get there? So what stake should I have today? Okay, that's the sort of mindset you're in. So let's make some other assumptions here, and you might just want to make a note of these because you're going to have to work through the example using them. So let's assume that you think that there's going to need to be 20% equity pool created for a new CEO and 8% for the employees. Okay, so you think there's going to be a bit of dilution in terms of the creating that equity pool. And let's also assume that you think that actually 1 million isn't enough. You might need an extra 2 million in 3 years, in year 3. Okay, and so there'll be you still think you're going to exit after 6 years, so there'll only be a 3-year holding period for that second investment. But given that at that stage you'll have a much better idea about whether the business is going to succeed or not, you'll lower your discount rate on that to say only 40%. So you're going to put in 1 million and expect a 60% discount rate, and you think you might need to put in another 2 million, or somebody would need to put in another 2 million, and that would need 40% return, and for a 3-year holding period. Okay, so think how that affects the calculations. And this is just a little bit tricky. There's a trick to this, which I don't want to give you too much away, because I think it's good for you to go through the thought process yourself. But just think about how these two rounds interact with each other as well. Okay, so you know, you've got to, and so what I want you to do is to basically fill out a cap table which has this form, which is basically as any other cap table. It's got to add up to 100. And you know, what I want you to do is to fill it up so that in the round one, obviously in round one there won't be a second round investment, so you can ignore that, but round one will have the initial investment in the equity pool. In the second round there'll be the additional equity, but just assume there's no more equity options created in round 2, and then see what that means for each of those entities: the first round investors, the second round investors, the employees, and the founder shareholders, with those two assumptions. So you've done the first round, if you like, but the second round comes in, and then think, how did the second round affect the first round? So I'm going to put you back into groups at this stage. I'll give you a little bit longer than this time. I'll give you 10 minutes because this is a little bit, there's as I say, a nuance here. But then I'll ask you to declare how much you think the first, so yeah, what stake you'd need at each round. Okay, so everybody got it? Any questions about this before I put you into study groups? No, you all got it? Okay, I'm going to create breakout rooms now.
With this, or you want us to fill it in, or?
Sorry, say again.
Do you have a spreadsheet for this, or is there somewhere a material we can copy and paste to
there is. Unfortunately, it's all filled in. So I will post up a spreadsheet with all these calculations in it. But for the time being, can you do it the old-fashioned way with like paper and pencil, or with a calculator? Because I haven't. It would be quite good to post these as templates to fill in, but unfortunately, I haven't done that. Yeah, so if you can just sort of either memorize that, or I can leave it up. I don't know whether you can still see my screen during breakout rooms. Can you see? Actually, that's a good question. I'll leave it up on my screen just in case, but basically you're filling in a cap table for a two-stage fund financing round. Okay, that's what you're really doing, taking account of the two rounds and the four different entities: the round one investors, the round two investors, the employees, and the founders. Okay, good. I will open the rooms now, and I'll give you 10 minutes, so it'll be back at 1/4 the hour. Okay. Right. Okay. We're back. So how did you get on? Did you manage to sort out what the proportions should be? Maybe what we'll do is do the same thing. Put into chat. Start off with putting in how much you thought the round two investors should get. So for the extra sum in year 3, what did you come up with for the proportion of the equity that they would require? Okay, got Steve with 16.5. Yeah, Nick with 16.5. Got another one, then we're probably agreed on 16.5. So that is the right answer. Going through the same sort of procedure, if you're the round two investor, you'd need to get a much lower percentage of the company, even though you're putting in more money, because for 2 reasons, one of which is that the discount rate is lower. So you're only using 40 rather than 60, and it's only 3 years. So it's a much lesser amount you'd need if you were putting in even a larger amount of capital. Now, what about round 1? How did the cap table change as a result of having the second investment round? did it have any impact upon round one? And if so, what was it? So did you think it was the same, or did you think, if you thought it was, because before it was 50.5, but to make the cap table work, it's always got to work, right? It's always got to be add up. So if you put into the chat if you thought it was the same for number one, or whether you thought it was more or less. So we've got, this is the for the series one investor. So here we've got Baoli saying 42.16, very precise, for the round one investor. I should say what I'm meaning here is round one investor at round one, whether it impacts on the amount they would ask for in round one, knowing that there was going to be a round two. Okay, so it's not the round one investor at round two, it's the round one investor at round one. Okay, Nick says more, 61%. Anybody else coming in on this? Anybody agree or disagree? We've got 42 and 61. Okay, well, I'm going to go with Nick. Nick, explain to me your reasoning and how it worked.
Because well, in the kind of arbitrary example where you're trying to get to this final proportion, the first round investor is going to get diluted by the second round investor. So if the first round investor has to get to an ultimate 50.5%, then they have to take a higher proportion at the earlier rounds if they want to maintain or rather get to that percentage.
Yeah, no, exactly right. So it's almost like you have to work out what the second round dilution is going to be to know how much more you've got to ask for in the first round, right? So you said 16.5% in the second round, which is right. That's what the second round investor expects. And on this, in this stylized example, we're assuming that there is no other investment after that. So they're not going to, they will get their required return, getting 16.5%. But then how did that means you need more to begin with, because there's going to be 16.5% more shares created and you won't own 50.5%. So do you want to just explain to people the maths of how you got to 61?
Well, I just divided the 50% by 0.83, I think, which was the residual. That's
right. So it's like, you know that there's going to be a it's like you've got 16.5%. So 1 minus 16.5% is what's going to be left, and you've got that's 0.83, and you've got to have enough so that you get to 51% in the second round. So it's like you divide 51% by 1 minus 0.165. And maybe at this stage I should just show it to you on a screen, because it might be a bit easier to see this. And again, if this is all sounding a bit, this is only arithmetic, but it's important to understand. So if I just share that with you for a second. So what's happening here is, if you think about it working backwards, you know in round two that the first round investor has got to get their 50.5%. In that round, the second round investor, in order to put in the money in the second round, they're going to need 16.5%. All of the equity pool employees will be diluted by that new 16.5% of shares that have been created. So they're going to go down. So are the founder shareholders by the creation of those extra shares. But the round one investor, if they anticipated up front, they would actually require a higher discount, so that a higher proportion, so that when they do get diluted, they get to their 50.5%, because that's ultimately what they've got to, where they end up is you sort of anticipate the future equity that you've got to issue, and you work out that you need basically 50% of the company if it's successful at that point. So that's the simple mathematics of it. I should say that this is if that was true, then this would be an even more implausible venture capital target, because there just isn't a big enough pie. You know, you're requiring, you know, 60.5% up front, which means that the founders are going to end up with only 16%, which is a very low proportion. In fact, you're giving up, you know, a majority of the stake in the company for right up front. So this wouldn't work. This is the sort of the sort of conclusion of this story is this isn't a company which, if it needed £3 million and it was going to take 6 years to get to £3 million of earnings, and it was only going to be valued at 10 times its earnings, it wouldn't work. On the other hand, if you thought it was going to be valued at at a multiple of 20, and you thought, you know, and you thought it could exit more quickly, it could work. You know, so this is the way the VC method essentially, you know, runs. It really runs through what percentage of the company you actually need to own at any particular point in time. Let me just stop there and just check if anybody's got any sort of questions or about either the specifics of this, or even about the sort of you know, the technicalities of, or the philosophy behind the VC method, because it's quite important to understand sort of what's going on in terms of the reason why you're doing what you're doing. So has anybody got anything they?
Professor?
Yeah.
Can I just ask, why wouldn't those first round investors just insist on some kind of non-dilution clause? Why? I mean, I know the whole thing's not viable, but assuming it was actually viable, why would they bother with that math instead of just insisting on non-dilution?
Well, I suppose what you don't know exactly. Well, if you think it needs 3 million to get to the end, somebody's got to put the money in, right? So, and it might be you, it might be somebody else. I haven't actually said it's the same investor, but you can't exactly insist upon non-dilution if you're not putting the money in, because you will get diluted. So and this is dilution in the form of somebody putting in additional capital. So it's almost like you can't. It's not clear how you could not be diluted when other people are subscribing for shares, unless you said to the founders, you've got to give me your equity. So you can't really do that. What you have to do is just anticipate the dilution and then ask for more upfront. And that's sort of what's happening with if you like, with an angel investor, is that you might say, gosh, it's quite a lot for the angel investor. In Alan's case, if you remember his convertible note, they put in something like, what was it, 200,000, and they got 3% of the company. That's quite a lot of a company for 3%. And yet what they're really doing is intuitively, they're thinking, well, this will need quite a lot more funding in order to be successful. And so we will end up owning, you know, not 3%, but 0.5% of this company or something like that. So I think that's the way the investors think. They don't think they're not going to get diluted. They just make sure that they have enough of a stake up front so that after dilution, they make a decent return. Okay. Laurent, you had your hand up as well. Although I'm not sure I can hear you, Laurent.
So I was wondering whether in real life this could be even more tricky, because there you're assuming that everybody gets the same shares. But obviously, in some scenarios, people will be involved with preferred shares or Series A's that don't have the same rights, and they have preferential rights to commoners, to common shares. That probably doesn't bear any difference into the calculation here, but it's very important if the valuation was to change going forward, because some of the value would be preserved for the preferreds, and the residual value would go lower for the residual shareholders. For the company.
No, I completely agree, and that is indeed the topic of tomorrow. Really, is where does the value? How much value is there in the financial structuring, whether you have preferred or ordinary shares, and indeed in the legal structuring, because there can be some of the rights you have as a preferred shareholder are very valuable. And it can mean that you are protected in a downside scenario. So, you're absolutely right. Here, this is a very straight, that we're sort of gradually building up the sort of the complexity. Here, I haven't said that they're different shares. They would be, because founders and employees would get ordinary shares. This is, if you like, the proportion of the voting rights. It goes back to what I said right at the start of this session. It's the proportion of the voting rights is like this, but the proportion of the economic rights will be different from this. So the economic rights will be lower for the shareholders because they'll have ordinary shares. So hold on to that thought, because we're going to deal with it tomorrow. Any other questions on this? Otherwise, we'll just finish the session. So just to sort of, as it were, tie it all together, I think, which one do you use? Well, a lot of it depends on predictability and sort of how much you really believe the forecast, you know, how easy it is to predict the future. And I think that if you said the more mature a company becomes, I think the more it tends to move towards the DCF approach. So, for example, DCF is used a lot in later stage private equity deals or expansion capital deals and things like that, because the cash flows are a bit easier to forecast. There's still the terminal value problem, but you know, you certainly see a lot more DCF being used as businesses get more mature. I think that with high risk investments, and especially those where you know, they're going to have substantial periods where they actually don't make any money, and they haven't got cash flows to discount, as it were, then more often you use the VC method. And that's, you know, that might feel a bit sort of heuristic in terms of, you know, where did those discount rates come from that I was suggesting? But those are essentially born out of experience, that if you use those sort of discount rates, you make high enough returns that you manage to raise your next fund. It goes back to what Alan said yesterday, is that that's what's sort of driving this. And indeed, to some extent, you know, if it's too difficult, that's why in a very early stage ventures where it's almost impossible to predict the cash flows, because it's still sort of, you know, at the concept stage, that's why you use convertible notes, because you don't have to talk about valuation. You just say, I invest 50,000 now to get you to the next stage, and I'll take the price that's offered at the next stage. So you sort of kick the can down the road, and in terms of valuation, and invest now and just accept what the value is later on, which is why valuation, the convertible notes are very popular and are very heavily used in practice. So, how bizarre. I'm running this completely on time. This doesn't normally happen, but anyway, if there's no, are there any other questions on this before we take a break? Because we'll come back after the break, and we've got 3 what I think should be fun sessions. You've been through the hard bit now, the sort of chalk and talk, whatever that is, virtual chalk and talk. And then we'll come back and we'll be patching in Jason Goldberg, who, and we'll explain to you a bit about how the whole session's going to work. But we're going to ask you to be the board of directors of Fabulous to make a decision. We're going to put you back in the real position that this company was in. So that should be great fun. We've never done this before, so it's a bit of an experiment, but I think it should be fun. So we'll take a break now, come back in half an hour at 1/2 the hour, and hopefully then Alan and Jason will be joining us. Okay, so see you then. You've just had your morning cup of coffee, I guess, at this stage.
Yeah.
Yeah.
But my hands are still steady.
Yeah. So Alan, do you want me to hand it over to you, and you can sort of explain a bit about the background and how this is going to run this session? Because we're going to, I explained to everyone, this is the first time we've actually had the benefit of Jason being here. So we're going to run it in a slightly different way than we've done in the past. They've all had the Fabulous case, the Fabulous pitch deck. So hopefully you've all had a chance to read that. But But Alan, were you going to sort of take us through the early days, and then we were going to simulate what actually happened, as it were? So
Yes. Good afternoon, Jason.
Hi, Alan. How are you?
Good. So Tim, if you've done this, stop me. But for the class, the structure of this segment is we're going to take you through the history of a company that Jason founded, or company or companies. You'll see why I use that distinction. And I'm going to start by giving you a quick history of the first part of the story. Then we are going to have Jason actually, who actually give a presentation to you as if you were the board of directors of the company. And it is literally the presentation that Jason gave us as his board of directors at the time. And then we're going to have a discussion in your what do you call them, breakout sessions. And then we will get your thoughts and then have a discussion. And we're going to cram all that into 50 minutes. So the quick introduction is Jason and a couple of friends. By the way, maybe I'll start a bit earlier. I have known Jason since the early 2000s, and it's hard to say how many companies I have worked with him on because all of his companies pivot multiple times. So it's somewhere between 5 and 15, I think, at this point. So Jason and I go way back. He started a company called Fabulous because he and a couple of his co-founders had an insight, which is that as social media was exploding, there was a segment of the market that was underserved by the mainstream platforms. And that was a place for hip urban gay men to meet up, to have the functionality of Foursquare, of Facebook, of Twitter, and the other social media platforms. And so we started a company called Fabulous to build that set of platforms focused on the hip urban gay male demo. We raised about $1.5 million from a small group of very high profile investors and launched the product. The product it didn't flop, but it sort of muttered along or stuttered along and wasn't sort of exploding out of the gate, except for one part of the product, which was the sort of flash sales segment. And Jason, who has many wonderful attributes, but one of which is he has somehow genetically is not subject to the sunk cost cognitive bias, has no problems sort of saying, okay, that was wrong, we're going to try something else. So Jason and I had a number of conversations where he told me that he didn't think that the Fabulous idea was working. I'm, by the way, collapsing a lot of information into a 2 or 3 minute intro. What should we do? We had about $1.2 million or $1.3 million of the $1.5 million left. And Jason said that when they looked at the behavior of the Fabulous customers on the flash sales part of the site or the service, that he thought that was actually an idea that could really fly. So he and his co-founders built a deck that you'll see in a minute, outlining the proposal for a new business. And we had a number of discussions with the existing board. In our case, like most cases in startups, there's a significant overlap between the board of directors and the large shareholders. It's typical in a raw startup or early stage startup for large investors to also be on the board. So we called the board meeting, and Jason had sort of a high level discussion with each of the board members, and the board was convened, and Jason gave the presentation that, Tim, I think we're going to share now, or have we shared it already? Tim, I at least can't hear Tim.
Yeah, Tim, you're muted.
You're on mute, Tim.
Sorry. Yeah, we haven't shared it, but we can put it up on screen. Jason, do you have it? Do you want to share your screen?
Yeah, I'll just screen share. So,
yeah.
Alan, thank you for the intro.
Yeah. So maybe we'll just quickly, if there are any questions, because I just gave you a sort of a 9-month history in about 3 minutes. So
yeah.
If not, we'll now convene the board meeting of Fabulous, and all of you in the class are board members.
Okay.
Great, thank you, Alan. And thank you, Board of Directors, for giving me time today to chat with you about the future of Fabulous, which we are now going to start calling Fab, F-A-B. And so let me share my screen. I know it's been quite, a fast journey over the last 9 to 12 months, but we're proposing that we make a very major change in the business. And it's a change in the business we're proposing, not just to go find the shiny new thing to focus on, but because we've studied what we were doing over the last 9 months, and we think we have a unique insight into one aspect of the business that's worth really leaning into and making that the entire business. So let me walk you through a few of the slides that we put together here for the board's consideration. So what you see here is what we are proposing that we relaunch Fab as, which is the daily design for everyone. So a flash sales website featuring everyday design, where everyone would get an email every day inviting them to discover our curated picks of design. Now, you might be wondering, how did we get to daily design deals from what we were doing, which was a gay social network? And I put together a lot of slides. I'm not going to go through everything here, but the short story is that I look at it as kind of like this yes, but so. And the yes is our team is highly capable of building world-class products, and we've achieved 130,000 members so far. But something happened. Something happened over the next few months that we observed. The first thing we observed is that our team is no longer bullish on the gay market. We looked at that a lot of the requests from our users on the gay market were really to use our app not as finding places to go, but just for hookups and sex. And that's not something that we really wanted to do. And what we are excited about is selling stuff. And a couple of months ago, we launched something called the Big Gay Deal of the Day. And just kind of out of a kick, just for fun, we said, well, we have 130,000 members of Fabulous. We have 40,000 of them that are logging in every week, 10,000 of them every day. And we said, what if we just tried offering them a curated deal every day to see for it? And a couple of things happened. One is we sold a lot of stuff, and we sold $35,000 worth of product just in the last couple of weeks. And this is from a company that had nothing to do with sales before. We were, just a social network, and we just said, hey, here's the one product that we found each day. Sometimes it was a chair, sometimes it was a cheeseburger, and we just saw that people loved what we were curating, we were picking out. And then the other thing we observed the last couple of weeks is that it wasn't even a gay deal of the day anymore. That we found half of our buyers were women. That people really liked the products that our team was curating, and that this was something that didn't really exist in the market. That flash sales you might have heard of have recently become something that a lot of folks are talking about. There's a lot of flash sales in fashion and other categories like kids products. You might have heard of Gilt.com in fashion, or Zulily in kids products. Well, we really think we're the first ones to offer this in the design category. And my co-founder, Bradford, he's a design kind of curator. Like, this guy can pick out products like no one I've ever met before. And basically what I want to do is I want to take the $1.25 million that we have in the bank and put all of that towards this one thing. And what I'm proposing is as follows. I'm proposing that we shut down the website as we have it today. We shut down the gay social network. We take 2 to 3 months maximum and build basically a whole new product called fab.com that is all about daily design deals. And we relaunch into that. As part of that, I don't know if you recall, board, but I invested $250,000 of my own money to buy the domain name fab.com. And we'll write off that loan that the company owes me for that $250,000, and I'll just invest that into the company as well, as to more equity in the company. And I really think, look, I'm convinced of this. Like, I don't want to spend another dollar, let alone $1 million of your money doing something that Bradford and the team and I don't have confidence in. And I really see this as like, there's all sorts of different ways to think about pivots. We've been iterating on product, and now we're really pivoting our way into a business model. We're leaning into something that we see is working. And I also think this allows us to go from doing so many things, from doing a lot of things all at once, to just doing one thing, which is this daily deal. And look, I know I sold all of you on the gay market, and as a gay male, this is my market, right? But I just don't believe in it anymore. I just don't think that we're able to build a $100 million revenue opportunity in the gay market. But I think that in this design space, it meets these three criteria. That one, it's an area that the team is passionate about. The second is we're convinced this can be a $100 million business. We think we can go from the 140,000 people that we've got signed up for this already, it's going to appeal to our existing members. It's going to bring in new members. And I think in the critical thing as to do we have a company for the long term, we'll be able to raise money for this. We'll be able to raise additional capital for this. And I don't think we'd be able to raise additional money for just the Gay Social Network. Whereas I think that if we get out in the market in the next couple of months and we show that we can, curate products and, select them and have people, buy them on a daily basis, and that we'll be able to raise lots of capital for this company, that we're leaning into a really, really hot part of the market with the fresh product offering. And so basically what we're saying is we're going to pivot the entire business from the gay places and deals, and that we're kind of selling, that we turn into like selling stuff that gay guys and other people really want to buy, into this kind of very specific focus on design. And we're going to be known as, Fab is going to be known as the company that's all about design. And so the way I kind of draw it out here is, we were at first in the life cycle of this company, you see how fast we've been iterating. At first we were building kind of like the gay Facebook, and then we worked on kind of gay places, which was kind of gay Yelp. And then we added like check-ins and kind of seeing who's where, that became gay Foursquare. And then more recently, we started this kind of gay Groupon, the gay deal of the day. And that's where that aha moment came, which allowed us to go from this incremental to a step function to now saying, okay, we have confidence now in this being our one thing. So I'm going to send over the deck to all of you. I put screenshots together here. You can see the categories we plan to be selling, why kind of our market analysis, why we're making this pivot, why we think there's a really viable space, how we see the business model working, some comps in the market around recent companies that have recent very high valuations that we think we could really own the design segment and achieve a very high valuation like these companies. And I think the next steps here is I would like to formally submit for board approval. I don't want to spend another dollar on the old thing. And basically what we would do is we would cut our burn. So we'd reduce all non-essential burn for us, kind of spend for us to just focus on building this. We're giving our team 60 days to launch. And during those 60 days, we're going to launch off, basically we're going to be lining up the first suppliers, building some pre-launch buzz. And then we're going to launch V1 of this product and go raise additional capital and build a company that all of you are really proud of. Now I'll leave you with this. You have two choices here. Actually three. One first choice is we can keep doing what we've been doing, which I don't think is going to get us too far. And I don't think I'm too excited about it. So we might need to find another CEO, but we could keep doing the Gay Social Network business. Option two is you support my plan, which is to pivot to the design deals. Or option three, I can give all of you your money back. We have 1.2 million left. Most of you we've made mostly whole what we've invested so far. You can get your money back, and if we just go on our separate ways, and I'll probably go start a different company. So I submit to the board three options for your consideration, and I hope that you choose the one that I've hopefully shown you that I think is the right path.
Terrific. So I think what we'll do at this stage is, rather than ask I don't think we'll let you ask questions at this stage. I think what we'll do is we'll put you into groups for 5 minutes. Generally boards have 5 to 6 members, so I'm going to put you in groups of 5 or 6, and you've got to make a call, 1, 2 or 3. So one was that the company should continue doing what it was doing, possibly without Jason there. The second one is you agree with his to the pivot, or 3 is money back. Okay, so, and at the end of you'll be in 5, there's 5 groups of you. So at the end of that, I want you to put into chat 1, 2, or 3. Okay, and then I'll tell you. Then we'll sort of invite questions, or we'll take you to the next stage. We'll also tell you what really happened as well. So I'm going to create the rooms now. We're just going to do this for 5 minutes, right? So we'll get you until 5 of the hour. Okay, so
yeah, and if Jason we might be put in rooms, but we don't have to join them. So you can just put that. You can click later, Jason.
Sure. Thank you.
Okay, so I'm going to open all rooms now.
Tim, why don't we put up for auction having Jason join your room?
Yeah, good.
All right, I'm going to go get a cup of coffee.
Now we have to wait for everybody to go before we say anything, Jason.
Okay.
Yeah, I'll just check if I need to do any admin here.
Are you just going to give them 5 minutes, or are you going to give them a little bit longer?
I think it would be four groups of people, since I collapsed one of them into the others. So so do you want to just declare what maybe one person in each group could declare? I don't know whether you actually work this out, but if you put if you could declare which of the options. So 1 is carry on, do what you said you were going to do, use up the rest of the money. 2 is support Jason's pivot, and 3 is money back. So let's see what we get on chat. So your answers, please, boards. Okay, you've got your first vote. Mataza, which was your group? Maybe you can't remember the number.
Yeah, I don't remember the number, but it was Brendan, myself. I don't know. Brendan, do you know what was the number?
Yeah,
no, he doesn't
worry.
either.
Number 4.
You guys know who you are. Okay, another 2 from Sahel. Okay, you're doing well so far. Group 6, option 2. Okay, what about the last group? 2. You really are the arch salesman, Jason, because normally when you're not here, 3/4 of the groups will say, "Give me my money back." So,
That's why I have Jason do the pitch instead of me.
Yeah.
Yeah. So, Alan, let me hand it back to you in terms of maybe we want to check with people.
Have we got all the groups in? Have we got all the groups?
Thank you for your confidence. I appreciate it. I'll spend your money as wisely as possible.
Oh, hang on. Somebody's given 3. Someone's voted 3.
Oh, wait a second. We got a 3 money back. So we have got a money back guy. Okay.
Yeah, because I didn't think all the groups had reported. Do we now have every group reporting? 1, 2,
that's it now. That's
5
it
groups.
now.
Yeah.
So, Imani, do you want to just give us the, since you're the dissenting voice, could you tell us, could you give us a sense of the discussion?
Oh, there's another group that said 3 there as well.
Oh, right, Baoli as well. So good. So maybe we had some people who were declaring for both for the same group. So we got, okay, that's a bit more normal. Some 2s and some 3s. So yeah, Imani, do you want to go first?
Yeah, well, the first thing is that we didn't really understand any differentiator in the design. There's already many companies working on that, so we didn't see any differentiator. And the second thing was that we felt like the company already pivoted quite a lot from gay Facebook to gay Groupon and many things along the way. So we didn't feel like this will be the winning pivot.
Okay. Jason, do you want to have any response to that? That not especially on the not really a differentiator. There were plenty of other flash sales sites going at the time, and so why was this going to work?
Yeah, I mean, look, in the deck, I showed some examples of the products that we'd be curating, and we really think it's original, and that there's not many places where most people can buy these products. That a lot of design has always been kind of out of reach for people, and something that they see as kind of pedestal pieces and very expensive, and we think we can curate and make them affordable for everyone, and bring design to the masses. And we think it's a big opportunity to do so. similar to what Gilt has done in fashion and made kind of any fashion available to anyone.
Yeah. Any questions anybody had? You know, even those who voted yes, were there any questions that were, you know, which were particularly worrying you in your discussions with the board?
Back to just quickly the last group who voted 3. One of the, I mean, we knew this was a challenge, but there was also a lot of effort spent in curating products that you couldn't find on Amazon. And so, because one of the kisses of death of e-commerce is if you're competing with Amazon. And some of our, Jason, I don't know what the percentage was, but most of our products you couldn't find on Amazon. Some you could, but most you couldn't.
Yeah.
We've got a couple of questions, Tim, and participant hands up.
Okay, so shall we go to Shahira? Sorry, I've got that wrong probably.
No worries, it's fine. It's Shariar.
Shahira.
Yeah, just very quickly. So if I understand it, it's something similar to Etsy, where you're kind of building a platform, putting designers together with customers. So one of the concerns we had, I'm the same group as Imani, is how do you manage quality control? Because there was a startup called Keaton Row, I don't know if you heard of it, that specifically focused on the women segment and trying to put designers in touch with women and offer them sort of curated sale products for their design needs. But it failed because they weren't able to manage the quality control. So Gilt manages everything centrally. So you buy from Gilt. And when you put designers in touch with customers, I think, unless I misunderstood the value offering, but how do you answer that?
Yeah, it's a great question. And so we consider Etsy to be kind of a two-sided craft marketplace. So you have, you know, kind of an independent designer who doesn't know how to mass produce. You kind of do made per order, maybe make 50 masks, let's say, or 100 masks to wear, like in COVID days. But they don't know how to make 1,000 or 10,000. And our team is highly trained and skilled at going after the designers who they can mass produce, but they don't yet have mass distribution. And so, as Alan was saying, you know, they're not on Amazon yet, but they can make thousands of this chair. And they're just, you know, then the traditional way that they've been selling is by physical retail outlets, kind of, you know, dealers around the country in the US at the time, who would, you know, basically buy, you know, let's say every design furniture shop in each city would buy, say, you know, 10, 15 of the chair, and then have kind of a process to order more. And we're just going to go direct to the consumer and give them much more reach and give the designer direct reach to the consumer. We do plan to do quality control. So we do plan to curate every product to make sure that we inspect the products, that they are quality products, and also to make sure that the designers are shipping as fast as possible. We don't plan to take inventory at this time. We plan to have a process by which orders come in through us. We then relay to the designer that they need to ship this within a certain number of days, they guarantee, and that they then ship it out and let us know. And we'll be responsible for all the returns, refunds, chargebacks, all that stuff.
Okay,
thank you.
Okay, we've also got a question from Steve as well.
Yeah, thanks, Jason. Can you speak a little bit to the experience in your team and things like merchandising and buying? Because it sounded like from what you just said, it sounded like there is experience in your team, but I didn't really get that from the pitch deck.
Yeah, I mean, so part of what we're kind of leaning into here is my co-founder, Bradford. He was basically the top salesperson at a company called Design Within Reach for several years before I poached him to come work with me. And so Bradford has he had this kind of like, wore two hats. One is he had one of the biggest followings of any gay blogger, but also he was the top salesperson at Design Within Reach. And he knows everyone in this industry. So he knows all the designers, and he's like the curator. He's like this king of quirk. He just knows great product. And And we're going to need to hire our own people, but Bradford knows exactly who to hire in terms of merchandisers and operations people to kick this into action. The rest of our team, we're product people, and we build products like social media, and was our previous startup that we scaled to millions of users. And we think we can do this. We think we can build this. And it's a good combination of software developers and design curators, and together we can do that.
Okay.
There's a few questions in the chat.
Yeah, do you want to take them, Kathy?
Sorry? Oh, okay.
Do you want to go through those, Kathy?
Yeah. So Axel was just asking about cash flows and the cash flow for the pivot and the working capital. Would they cover the balance funds?
Yeah, look, we have $1.2 million in the bank right now. We're spending a little less than $50,000 a month. So, we don't think it's going to be, we think we can get this launched and then go raise capital then. We think we can launch the product in about 3 months and then go raise capital afterwards.
Yeah. And Imani, do you want to come in with your question actually? So I'm not really sure I understand your question. So do you want to just shout out?
Yeah, I was wondering if it's a drop shipping business model actually.
Yeah, that's our plan. We don't want to take inventory. We just want to, it's what you call drop shipping. Basically, an order comes into us, and the careful thing for us is we need to work only with designers who are willing to basically commit to our standards. So we're going to need to build technology to let them know whenever an order comes in, and they're going to need to ship out to the customer as soon as possible.
And a couple more, I'll just summarize so we can get plenty in. So from Sifa, is the remaining capital going to be enough to fund the pivot? And from Baolai, our members are our core values. So how do your migrating members, how do your migrating 110K members to fab.com create value? Actually, Baolai, you have to summarize that one. I don't really understand it.
One thing, Kathy, well, Baolai should say, but also, Jason, it might be worth taking just a minute because this was quite a clever thing that the team did. The decision to, well, let's see, am I jumping the gun here? I'm going
watch it, Alan.
I'm not going to finish my comment.
Jason, my question actually is our core value at the moment is this 100K members. They've been loyal with us. We generate value from them. If we change the website to a new type of website, how are we going to keep them? And are they going to stay loyal with us? This is the key things for future success. I want to hear more about that from you.
Yeah, thanks for the great question.
Jason, we should just be careful in answering that. We may want to defer the question because as I was about to spill some of the beans, your answer to this might spill some of the beans, because I think we want to talk about the decision the board actually made and then what the team operationally did immediately after that. So
sure.
Good question. Why don't we'll come back to it a second.
Yeah. Okay, I think that's probably most of the questions, Alan. So do you want to spill the beans on like what actually happened and how it felt to you, because you were on the board, right? So were you chair of the board at that stage?
I don't think we had a chairman. Anyway, I had been drinking heavily, so I was. I think we should let. I mean, I have a bit of a sort of a position here, which is that, Jason and I have worked on a number of companies before, and I would always work with Jason on no matter how crazy his idea was. So I was, for a couple of reasons. One, I have a lot of personal faith in Jason. Second, we haven't talked about this, but we'll talk about it a little more during the week. The venture capital model, you will recall from yesterday, is not playing it safe. The venture capital model for early stage deals is, again, I I'm an American, so I use American sports metaphors. It's every time in baseball you're at the plate at bat, you swing as hard as you can, hoping to hit a home run. And the rules of the game are that everybody understands you will strike out. I don't know what any of those terms are in cricket, but any event. And getting even 80% of your money back, which is what Jason was offering the investors, is kind of, there's a cliche here in the Valley called, it's like kissing your sister on the cheek. You don't get any kudos by your partners or from your partners for getting 80% of your money back. Because what you're supposed to do, what your job is to do, is to lose some money taking big risks, but make enough money on some of those risks that you make on balance a lot of money. So I was, and again, Jason and I had a lot of conversations prior to the board meeting to prep for the board meeting, but I thought it was a good idea and I was fully supportive of it.
Yeah. I should also say that, go ahead, I'm sorry.
I was going to say, but Jason, you may want to, from your perspective, I think it would be interesting to sort of say what the board did and then walk people through the next 3 months or 2 months.
Yeah. So the first thing is that I knew without a doubt that the board would say, keep going. And the reasons why I knew was one, so my previous startup, Social Media, which Alan and I did together, we sold that in under 9 months. We raised about $900,000 and sold it for about $7.5 million. Not a huge exit, but a considerable multiplier. And we gave our investors a good return. And I had investors who complained to me that they would rather, that they were really mad that I sold the company, that they wanted a bigger return. And so I knew that the investors, here and there, they get 80 cents on the dollar versus a chance to get 20x or 50x. That they 99 out of 100 times they were going to say, just keep going. We trust you as an entrepreneur and do the best you can. I also knew that no sound VC would tell an entrepreneur to keep working on something they don't believe in. That's a lost cause as well. That if the CEO, founder doesn't believe in the product, there's no way the VCs can make it work. And so I knew the only option to the VCs was to say keep going, to follow my path. The fact that I also put $250,000 of my own money into it, that I knew there was just no way that that anyone was going to ask for their money back. And if they did, it would have been I think the rest of us would have all been like, okay, thanks, see you later. We're going to keep moving. So the deck that I walked over to, the board meeting was on February 28th. I think we approved it formally about a week later. So early March. We shut down the website and started building the new fab.com website. And we ended up actually giving ourselves till I think it was June 6th to launch it. So we gave ourselves like 3 months to launch it. During that time, we had this wacky idea of, we had 130,000 kind of people signed up for the the gay website. We knew that gays, not to over stereotype, that gay people tend to like design and kind of good products. And we thought that this could be kind of our early influencer kind of audience. And so we had this wacky idea of launching kind of a pin board of showing people the kind of products that we would be having on the site, and then giving people incentives if they invited their friends to also join. So if you sign up 5 friends pre-launch, that you got $25 whenever they made their first purchase of $100 or more on the site. And it was actually back before anyone did those kind of viral kind of marketing things. And today it's like you get these all the time. And so we ended up having over 500,000 people signed up for Fab when we launched in June of 2011. We sold $60,000 worth of product on our first day, and we sold $1 million within 10 days. I'm sorry, within 20 days, excuse me. And we sold $20 million within the first 6 months. And we, within that first kind of 6 months, we did 2 venture capital rounds. One was for, I think it was somewhere between $8 and $10 million. And then another was for, I think it was $25 million. And before the 1 year anniversary of the pivot, the company was valued at over $200 million.
And Jason, what was revenue in after the first 6 months? Because we launched mid-year.
Yeah, yeah. So the first 6 months,
because I remember, I thought it was about 120.
Yeah, so the first 6 months was, so we launched in mid-year, from July to December was about 20 million. And then from the full next year, so 2012, so this all happened in 2011, 2012 revenue was about 112 million of sales through the company. And do you want me to keep going now with some of what happened next, or?
No, I think we'll just end the class here, and everybody who voted 2 did it right, and everybody who voted 3. I think, why do you keep, because the history of the company illustrates a number of the issues that we're talking about in the class. So why don't you keep going?
Yeah. So a lot of interesting dynamics here. So one is we grew super, super fast, and faster than we ever could imagine. And it was also during a time that, let's say, the VC markets tend to go, like, you have kind of periods of darkness and then periods of euphoria. And this was the beginning of a period of euphoria. I mean, it was like an era where, VCs were just starting to really jump into things. And so now you have, unicorns left and right today, and you have, companies raising hundreds of millions of dollars, very quickly all the time. Back then, that was just starting to happen. It was really the very beginning of that kind of phase. And we very quickly became the darling of the VC world. I remember actually, we raised, money from Andreessen Horowitz, A16Z, which was, the most attractive firm at the time and still one of the top, firms. And we never even did a in-person partner meeting with them. Like, so typically the whole process is that you have to fly to Silicon Valley and do a dog and pony show and kind of, pitch meeting. And literally the whole thing was a Skype call. And then, the partner said, so we'd like to give you, $25-30 million. And as long as the valuation is under 200, we'll do the deal. And I was like, wow, okay. And I was like, this is how the world works now. Okay, interesting. Speeding up a lot, as Alan, as I said, we sold about $18 million in our first 6 months. We then sold 115 million in the next 12 months. And then we grew too fast. We set a plan to hit 250 million in sales for the second full year. So imagine this trajectory where you've done 18 million, 115 million, and then you set a plan for 250. And we were not able to achieve that. We ended up having about, basically a flat year, about another 115 million in sales in that second full year. But we had built an expense base up to go after the 250. And so we required a lot of capital to run the company. We also
briefly mentioned, because there was a strategic event in the company's history that increased our cost base a lot. So you might talk about going from the dropship model to the we have to do everything ourselves model.
Yeah, so there are a couple of things that happened. And they all kind of, when you make these big decisions, and then, they're not isolated events, so they tend to be multipliers on top of each other, right? So we made a decision to, one is to expand internationally in 2012. And so we bought a couple of companies, one in Germany, one in the UK, and decided to take our model to Europe at the same time as we're operating in the US. And then what happened is, as Alan alluded to before, is when we first started selling, we really were kind of like master curators. I mean, it was like you would have a product on Fab that it was a designer who they're graduating from Etsy, so they were more than just a craft designer. They were not on Amazon yet, and we basically the average was about 45 days it took from kind of us discovering a designer to them appearing on Amazon. And we saw that go from 45 days down to 24 hours, like that. Like it became like in our second year of operation, that literally it was like Amazon was just letting us curate for their sales team to then just go in and list the product Amazon. And so what happened is Amazon started selling the exact same products as us within 24 hours as our featuring them on Fab. And then Amazon was able to offer free shipping, almost no margin, and have all the whole marketing kind of power machine of Amazon behind it. And that's where it really became a real struggle for us. And so one of the strategic decisions that we took was to no longer rely on drop shipping, but to take inventory and put kind of the products in our warehouse to try to keep up with Amazon in terms of the quality control and also the free fast shipping. And that was a huge expense that kind of layered on top. And so you think one is we couldn't hit our top line growth. The second was we took on the expense of another region. And then the third is we just got crushed by Amazon, and we made a strategic mistake of kind of doubling down on kind of trying to fight against Amazon by investing in warehousing and in inventory. And yeah, so long story short, we, by middle of 2013, so only a couple of years after the pivot in 2011, we raised capital, raised about $150 million at a $1 billion valuation. And we knew that that wasn't enough capital to run the company. So we actually needed to raise 300 million. And when we raised that 150 million, the plan was we needed 300, and we immediately just started cutting costs. We cut our headcount over about 2 or 3 different layoffs. We ended up cutting about 80% of the headcount in the next 6. We basically the business couldn't survive. So we had built up a company that had very fast top line revenue, and as the competition got fierce and as our expense base got too high, we couldn't sustain it. We ended up selling the flash sales business for very low money. It was about $25–30 million worth of stock after raising hundreds of millions of dollars of capital for it. And we had a private label furniture company that that kind of was an offshoot of the business, that we then spent about 1.5 years bolstering up, and then sold that for very little as well. And that was basically the end of the Fab story. So by February of 2016, we sold the last part of Fab, and none of the venture capital investors that came in after 2012 made any money. Now I will tell you, there's one angel investor who invested right at the time of the pivot. So he put $100,000 in around June of 2011, and he sold out at a 500 million valuation. But pretty much everyone else lost their shirts.
And unfortunately, that angel investor did not have the surname Morgan, I believe.
No, he did not.
Yeah. Yeah. Well, it's
dialing into this call from my yacht.
Yeah.
But it's a fascinating story, right? Because this is a company that went from $1 billion round, through to essentially not quite shuttering it, but shuttering it within a year or two, right?
I mean, think of the pivot was, in Q1 of 2011, Q2 2011, 2012, 2013 were, 100+ million in sales, $1 billion valuation, and by middle of 2014, we knew that the thing was basically dead in the water.
Right. Yeah. And in retrospect, do you think it could have ever worked, or were you always subject to the Amazon threat? Did you think?
It's a really tough call. I think that if we had, I guess it depends how you define the word work. Like you say, could it have worked? If we had decided in 2012 to build a nice, profitable marketplace business at, say, 80 to 100 million in revenue, and just get profitable on that, there's probably a really good chance that we could have just optimized the business to be kind of, sort of like, let's say, sort of like what Etsy's done, and kind of just say, okay, we're going to be a marketplace for designers and design enthusiasts. We're not going to try to grow too fast, but we're going to grow enough to be a healthy business. So maybe went from 80 million to 100 million, 120 million, 150 million. And I think if we just had patience to be a good business, not a $1 billion business overnight, that the story could have turned out differently. It's very tough though, because there is we would find designers and then Amazon would make them heroes. That was really tough. I mean, I look at we made a lot of unforced errors ourselves, but then, the Amazon juggernaut was something that the better we did, the more Amazon was going to try to crush us.
Mm. Yeah, well, you're not alone, right? This is that's not much of a doesn't make it any better, but it's not unusual.
Not much has changed, right?
Yeah. Now we've got a couple more minutes. If anybody's got any burning questions for Jason at this stage, I mean, the sort of the learning outcome of this is pivots happen, and that's exactly what the venture capitalists are sort of supporting. If when the horse and jockey analogy, they're off. That basically they're mainly backing the jockey actually, and the horse, because the horse can change midway through the race.
Tammy's got a question. Tammy, do you want to go ahead?
Sure.
Hi, Jason. I was just wondering, why did you decide to compete with Amazon instead of offering to sell your services to him, to others, to the company?
Yeah, I mean, Amazon, we did make some feelers to see if Amazon would be interested in buying the company, and they did not engage at all. Amazon typically doesn't buy other companies in e-commerce. They try to buy more technology. When they have bought e-commerce companies, they bought companies that typically, were already Zappos is an example. They'd already really worked things out and kind of were doing pretty well. But I think Amazon just figured they didn't need to buy us to compete with us, that they probably just realized that on their own. I will say that shortly after we closed a financing round at about $200 million, we did get some feelers from Groupon, who basically said, well, why don't we just buy you out for around $400-500 million? And we kind of laughed at it at the time. We kind of said, we're going to be $1 billion company. Why are we going to sell now? And we just raised, like $40 million, and why would we sell now? So timing is everything.
Yeah, indeed. Any other questions from the class? We've got one more minute, but I think that
your success put you on Amazon's radar, and that's why they entered the market, or they were always planning to enter the market anyway?
Probably a little of both. I mean, we saw that several times during Fab's life cycle. They launched several variations of products that were in the kind of like parts of their website that were in the kind of the Fab area. And sometimes we'd kind of look what they're doing with amusement, because it seemed like they never got it right. So they had like a Amazon deals, and they had an Amazon design, and they never just really seemed to get it right. And then it wasn't until we just saw that, okay, they're just listing our products on Amazon just as they need the product, that we realized that they don't need to do anything. They just put the product up on Amazon, and that they would just beat us that way.
Yeah, well, Jason, thanks ever so much for joining us. It's been really, really great to see the legendary sales technique, and the fact that you are very, very convincing. There's no doubt about that, which I think is an entrepreneurial skill in itself. But thank you for leading us through that, and it's been really fascinating to hear what happened from sort of 0 up to $1 billion and then back down again. So thanks very much, and we hope to get you back at some point, either virtually or in person, indeed, at some other future class. But thanks a lot. And now we've got a break of 30 minutes until we have Kevin Law. So let's give a digital hand to Jason. Thanks very much.
Thank you all very much. It was a lot of fun, and have a great class.
Yeah, thanks a lot.
I'll talk to you later today.
That's fabulous.
We'll come back at 1/2 the hour. So thanks a lot.
Thanks, Jason.
So
people are back now, so if you want to stick videos on, if you've got the bandwidth, then we can get back together again. So it's a great pleasure to have Kevin Laws here again. Kevin's been a loyal supporter of this course, it has to be said, over the years, both in person and now virtually as well. And Kevin, as you will know, as I explained to you, is CEO of AngelList. And I guess I guess many of you will know a bit about AngelList, but may not know too much about it. And so Kevin, do you want to just give us the sort of what your market position is, how you make your money now, and then maybe we'll go back a little bit to sort of how you morphed into what you are today. But do you want to just give sort of the 2-minute sort of explanation about what AngelList does at this stage?
Yep.
So AngelList, what AngelList does is split into three parts. The first part is we power most small funds and many mid-sized funds that are doing investing. The angels that grew up into running small or mid-sized funds all use AngelList to both raise their funds from investors on AngelList and to deploy them into companies. We're putting about $250 million to $350 million each year through the platform into small companies, into a couple thousand small companies a year at this point. That's roughly, it used to be, last year it was about a third of the market. This year, given how the market slowed and AngelList hasn't, we're up to almost 2/3 of the market at this point.
Wow.
So about 60% of tech seed funding, not the dollar by dollars, but by number of companies flows through AngelList. The second part is recruiting. First thing you do with dollars when you raise them is you go hire. So we run a recruiting site that helps people work for these startups. That is, at this point, I think the largest recruiting site for startups in the world. It's not just in the US. India is our second biggest market, and it kind of goes from there. And the third is we run a site for new company product discovery called Product Hunt, where when they launch their product. People who love to see and find and use new products, they all use Product Hunt to find out what those products are. And so for us, it's like all the components you need to get a tech startup off the ground is the money, the people, and the initial audience for your product.
Right. Okay.
So, and then business model, each of those is actually a separate company at this point, each with its own business model. For the fundraising side, we take a management fee of the funds that we help manage and a carry if we help them raise the money. On the placement side, recruiting side, there is a free product, but if you want kind of help sorting through everybody and we find the right person and get them into your company for you, that's a product that you pay an annual subscription fee for, and then we'll do that for your company. And then on the Product Hunt side, that's more of a media play. There's just advertising for the site and for the newsletter that goes out.
Right. Okay. Now, that's where it is at the moment. But of course, it wasn't.
Yeah.
It wasn't like that at the start, right? So do you want to take us back to how this started? Because as I understand, it wasn't even a business when you first started.
Nope, not at all. It was when we got the business started. It was not a business. It was a blog. We were just writing advice for early stage startups and how to fundraise. Primarily because it was right around when, because of the cost of starting a startup being so low, many more startups were starting up than ever before. And they didn't know how to raise money, and the traditional sources weren't writing enough checks to cover all these startups. They were writing single $5 million checks, not tons of $100,000 checks. Which is all many of the startups needed to get off the ground. Now the market's progressed since then, but that was what it was like then. So it was an advice site, which then morphed into a social network of sorts. Closer actually to a dating site, because people were asking us for introductions. They're like, great, thanks for telling me how to negotiate my round, but who am I negotiating with? Nobody wants to invest in me. So we'd make introductions to angel investors we knew. But because it was not really a business, this was a give back project, we're like, okay, we got to get ourselves out of the job of making these introductions. That feels too much like a job. We'll just post the contact information of these angels who are writing checks on the web, which was a bad idea. You don't want to post people who are known to be millionaires writing checks if you ask them nicely on the web. That's a bad idea. Don't ever follow that business model. So they asked to have their contact info taken down, and we instead stood up the site that is still up today, angel.co, which is kind of a social network where you can go on, post your profile, and we can figure out who's supposed to be talking to whom. that was kind of phase 2 of AngelList. Then we started to move into phase 3, where we had to get legal because we added a business model. So we had to get some law changes through the US Congress in order to make online financing and introductions work, so that we didn't need to re-regulate it as a full broker-dealer, which didn't work for the tiny transactions we were supporting. And as part of that, we got very well known. And at our peak, we had over 30,000 companies at one time that were raising financing. It was just too many to sort through, and we certainly couldn't, nor could any individual angel or institutional investor going through our site. And that's when we took the second pivot, and we never shut that down. It was just too overwhelming. The second pivot was into, okay, we're going to support the angels who are sorting through this and have the angels who aren't put all their money behind the angel who is, and they become the screen. So now we have over 250 angels or so on the site. Now they're like mini fund managers because the rest of the angels and investors went behind them, and they're sorting through all the startups out there and putting their money into these. And so we've essentially kind of reinvented traditional venture capital, come full circle back to it, except in a way where we took all the friction out of it so you can do it at these tiny check sizes and make it efficient.
Right. And so the interesting thing is that if you're a startup business, then you can't just post yourself on AngelList or even apply to be posted, right? You have to find an angel who will sort of support you and be your lead investor, as it were, who then goes out and sort of almost markets you to other angel investors, right? So
that's correct. So it is, if any of you have read Taleb, it's very much based on this skin in the game concept. The other angels will trust somebody saying this is the greatest company since sliced bread if they put their money where their mouth was and wrote a check into it. If they just, the company puts themselves up, we have 30,000 companies saying I'm the greatest thing since sliced bread. How do you decide between them? And so the angels know each other by reputation or personally or just by track record, which we now start to keep and allow the angels to communicate, and can say, yeah, as an investor, I'm going to go behind when Elad Gil writes a check into a company, or when Naval Ravikant writes a check into a company. I'm going to write my check into the same company and back them into it.
Right. And I should say at this point, and if anybody's got any questions as we go along, just raise your hand, and we will we'll let you drive this as well, because this is your opportunity as well. As these introductory ones are more to sort of get at the issues and how it all works. So Kevin, in terms of the angels and them actually filtering the opportunities that are available to them, are they just doing that completely offline? Is there any, like, if you're a budding entrepreneur, is the first thing you do, you sort of look on the 150 angels on AngelList, you start reaching out to them, as it were, separately from the AngelList network, or is there any marketplace there to get feedback?
No, that's correct. I mean, you can contact them through AngelList, but other than that, that is correct. Most of it happens offline. We may take a look at changing some of that, given the current situation of in-person meetings being kind of problematic here. We may try to support more online features for communications and things like that. But keep in mind that these companies are often nothing more than a PowerPoint or a demo product or things like that. It really is about that personal connection and judgment of trust between that lead angel and the founding team.
Yeah. Now, I see, Charles, you've got your hand up, so you take the floor.
Yeah, so how do you become, so if you're on the investment side, how do you actually become an angel, and how do you get onto the AngelList site?
Yeah, so it depends on what you're looking for as an investor. If you are an absolute beginning investor and you want to get into investing in startups, I usually recommend that you go on AngelList and follow some of the syndicate leads. Say, if you're putting money into a company, I'm going to go behind you with a check. You will see the companies that they invest in, and you can start to see the patterns that emerge from that and what they find important in it and what terms are typical these days because they do shift over time and things like that. You can learn a lot watching the deal flow and watching how they work out. Some of the companies work, some don't. Why? You can form your own hypotheses about that. But honestly, I would say 80% of it is stuff that you can learn just from watching the deal flow. So then if you are an experienced investor and you're now wanting to write your own checks, then you can go on and create a syndicate on the site. Start meeting companies. I mean, you're going to have some network of companies that you are able to access that you find interesting, that you can then connect to the investors on the site, and you would be the lead investor that everybody else backs behind. And if you've got a good track record of picking investments, I can get into kind of how to establish your track record with other angels. But over time, a lot of people will back you, sometimes to the tune of, $1 million per investment or $2 million per investment.
And how's the vetting of, because otherwise anybody can just sign up, say I'm an angel investor. Do you vet those people before saying, well, can you prove that you're an investor, or do you have, you are a millionaire or something like that?
So those are two different questions. Let me take the basic question because that's more of a regulatory question. Everybody on the site must meet the US standard of an accredited investor that is allowed to invest in private deals. That standard says that you have to have $1 million or more in assets over and above your house, or an income of, I believe now it's 200,000 or more, or 300,000 in combination with your spouse. That's the rule. We do check that and vet that and make sure the investors meet that regulatory standard. The second part of that is there another screening we do of the investors themselves? Very light. The primary screening there are the other investors. Will they back that investor? So the other investors tend to be probably even a better and tighter screen than we might be. Those investors, if they can't get a sufficient number, if you're writing a $10,000 check and you can't raise at least another $90,000 behind that check, we won't close, which means you need to find enough investors who are willing to back you. And these are reasonably sophisticated investors. There's another screening we do to make sure they know startup. It's not, you can't just say I'm rich because I'm a dentist and I'd like to invest. That you have to go through our funds for. So that level of screening is the main thing we look to, and it is a very tight screen.
Yeah, there's a question around that actually from Anna. So do you have to be a US citizen, Kevin?
No. So our international strategy is very complicated. We can accept money from anywhere if you want to be an investor, under the principle of what they call reverse solicitation. We did not go out in every language and say, hey, you should come to our site and invest. You came to us and you're under US law and regulation. So as long as you meet the US standards, you can come. The only place that's a little weaker is English language jurisdictions, where we do, because we're in English and we are saying come invest, we are regulated under most of the English language jurisdictions. So US, Canada, UK, where else? Singapore has said it's okay. Hong Kong has issued a letter that it's okay. Australia and New Zealand don't have anything specific with us, but nobody's ever complained about us. So we kind of still work there.
And in terms of in practical terms, how do you go from being a sort of a backer to a leader, as it were, to a syndicate lead? Is that something where do people put their track record on as having been a sort of following investor? They say, because I know whenever I've been on the side, it always says, I invested in company A, B, C. And of course, that doesn't necessarily mean you're a syndicate lead, does it? It just means...
No, we do identify those. There's a VIA. I invested via AngelList, or I'm the direct investor in this. But generally, no. Like, it's not that you would say, I backed a fund that went into Uber, therefore I'm a good investor. That's just a good way to learn what it is you're supposed to be looking for. Because just to give you some stats, like when we had those 30,000 companies up, something between 1% and 2% would ultimately raise money from anywhere. The other 98 to 99% would not. So if you really do have to learn what will make for a successfully raising company before you go out on your own. So that's kind of a level of learning, not a level of building track record. The track record really has to go when you start bringing companies. The way to do that is to bring companies to the platform that you are investing alongside, not through the platform, but directly because you know the CEO or other founders of the company, but you are investing alongside other investors with track records. So initially, people will say, oh, you got into a deal that Sequoia is in. Sequoia is a well-known fund, or that Mayfield is in. You got into a deal that a good investor is in. Could be a well-known angel, Peter Thiel is in, or whatever. You got into a investment like this, and it did well over time. The initial investments, other angels will back into that, other investors will back you into that because of the other investors in the deal, not you, but you're the one who brought it to the platform. That's how you build up your personal track record. And then over time, people say, hey, he brought us 7 great deals. They worked out well. They had good investors in them. Now he brings us an 8th deal that doesn't have these investors, but he says, this looks a lot like those deals. I now know what makes a good deal. I'm going to go into this deal. And at that point, now you do have enough of a direct investing track record that other investors will follow you.
Yeah. And just one other question. I'm going to bring Laurent in a moment to his hand raised. But in terms of the types of securities and the stage that you're at, these would be priced rounds, would they? Or would they also be converted?
It's about 50-50. Well, okay, it's almost all priced rounds. The form is either equity or what they call a safe or a capped note, which is essentially a priced round in a different format as far as early stage investing is concerned. But yeah, yes, they're almost all priced rounds.
Yeah, and if, for those of you who remember yesterday when we did the convertible note, so the cap is like a price, as Alan said. So that's what we're talking about. A safe is a very similar thing to a convertible note, but without an interest rate attached to it. So
yeah, or a repayment. Like everybody who's not in startup land thinks safes are crazy, but they make sense to us because we never expect repayment on a debt to a early stage company. Either they succeed or they lose everything. There's not a in between where they pay back your money and that's it. So it's a convertible note without actually being a loan. They never have to repay the money. They only have to give you ownership if it works.
And that's probably worth re-emphasizing, Kevin. Yesterday we mentioned to the class that no one ever does a convertible note thinking they're actually making a loan to the company. They're just making an equity investment in a cheaper, quicker, simpler way.
Yes, exactly. And so that's why for safe notes, they just dropped to the repayment thing. It was complicated and not necessary because nobody expected their money back. But don't ever use a safe note with a restaurant. Like they're not compatible. If you might want your money back someday, you want to use something more traditional.
Now, Laurent, I was going to come to you, but have you got your hand down or have you still got the question?
No, I'm still up
there.
Okay.
Yeah.
I was wondering, that's sort of a chicken and egg question, but how do you create the momentum? Because is it a matter for you to have enough projects that are showing on your website, and that creates the traction for investors actually to look at it, or how do you manage to create the momentum?
Right. So you mean us as AngelList? How did we kind of create the momentum? Okay. Yeah. So it kind of came in phases. Initially, we were well known. One of our founders in particular, Naval, was a very well-known angel investor with a lot of successful investments behind him. And it was initially his friends, but his friends were like the hot angel investors that everybody else wanted to follow. So the companies all showed up. Once the companies all showed up, the rest of the investors showed up. Then for a while, once we helped pass the law that made online investing legal, we were the only site that knew how to do that. Like we wrote the law, we knew what every in and out. So we had another kind of year and a half before anybody else got set up to do it. And in that time, like everybody showed up on our site. And so now it's like we are not a crowdfunding site. But if you look at any crowdfunding report, they will claim AngelList because without us, they will drop like 80% of the volume of what they're claiming to be crowdfunding. Like, we are pretty much the only one in our area. There are a few others, but they're rounding errors. And then there's crowdfunding proper, which is a real thing. It's just not what we do, which is a small sliver. And so that's kind of how we grew up. Now we don't do marketing. It's just that it's already all there. It's like eBay. eBay these days, I haven't seen an advertisement for eBay in years, but if you're going to sell something in auction, where else are you going to go? If you're a seller, all the buyers are there. If you're a buyer, all the sellers are there. That's the way it is now for investors and for starting GPs and angels, not for the companies anymore. That's kind of a different thing now.
Yeah, and one thing that I think is really interesting, which maybe people haven't quite.
Sorry, Laurent may have had a follow-up.
Sorry, yeah, Laurent, go ahead.
Follow-up question. Are you also working in Europe?
We were just discussing that. So we were, but via our office in the UK and passporting regulation to the rest of Europe. So we were just discussing how we are going to try to work with Europe post-Brexit. And the answer is we don't know yet. We're having to figure that out now. So we don't have a huge volume of European companies, and most of what we do through a fund that we created in the UK with our the leads of our UK offices. And that's more of a traditional fund. So that's how we're doing it for now. We don't have the same kind of lead backer model in the rest of Europe. We have a few funds that are doing that, but they're doing it via US vehicles. So we'll figure that out post-Brexit once we figure out the right jurisdiction to do it in.
Yes, you mentioned reverse solicitation as a key point.
Yes.
I was just wondering whether AFIM in Europe was an issue for you guys.
I'm sorry, the
Alternative Investment Directive, you know, that's.
Oh, yeah, AFMID. Yeah, I'm familiar with it. It generally has not applied to the true reverse solicitation. It does prevent us from going to Europe until we have a regulatory regime and saying, hey, come invest in this. So we do have a person in Berlin, but what they primarily do is look for startups to invest in, not for investors to invest in those startups. The investment comes from either their fund that they raised under UK law or the US investors.
Yeah. Now, one thing that it's not always immediate that AngelList does is it creates what I think we've discussed in the past. It's something like single deal sort of mini venture capital funds associated where you can sort of syndicate out. You can create the legal documentation and the like with a syndicate lead as being the sort of fund manager, and then all of us could actually invest behind that person, and it's like a single deal fund. Is that the right way to think about it, do you think?
Yes, we have 3 products. That was the first one we started with, was a venture fund that you knew what the investment it was going to make before you invested in it, and it invested in one and only one deal. So we had a single deal fund that went into Robinhood, the online brokerage, for example, and people invested in it. The fund then invested in Robinhood, and that's it. So there's a lead investor for that. That has morphed over time. More and more of the leads, as they got more sophisticated, started raising blind pools of capital ahead of time, also known as pure straight traditional venture fund. You raise a fund, you're going to invest it in 10 or 20 deals. So it'll be small funds. You'll raise a $2 million fund and invest it in $200,000 checks across 10 deals, for example. And then our most recent product that kind of is better suited and tuned to how anybody who's sub 200 million even would be advised to raise a fund. We call it rolling funds. And essentially it takes a fund model and makes it a SaaS model for funds. You are always fundraising as a GP. You don't need to go fundraise and then stop and then go invest for 3 years and then go fundraise again. You sign investors up to a subscription that they can start and stop anytime, and you're always investing out of, it's essentially investors sign up for certain capital calls, right, and not others. Great, I'm going to start investing right now, so I'm in every deal you're doing for the next 8 quarters, and then I can re-up and keep going, right? So what we're doing underneath is essentially each investment is a single deal fund, right? So, but we're doing all the accounting to make it work as if it's just this permanently open fund. And the reason that works so well is if anybody who raises their first fund, it will sometimes take them 2 to 3 years to raise that first fund. A long, long time. And that makes no sense to take yourself out of the investing game for 2 to 3 years. So just keep investing. It's just at first you'll be writing $50,000 checks. By the end of year 3, you might be writing $350,000 checks if investors see the deal flow and want to jump on board with your deal flow.
Kevin,
so that's called rolling funds.
Is the subscription a commitment, a capital commitment for the duration of the subscription, or can you opt out at any time?
So that is up to the GP. The GPs, the angel leads, they generally start without any restriction. You can come in, you can leave at any time. So they just get this quarter, you can invest up to, you know, $300,000. Fine. So that will adjust their check size accordingly. As GPs get more power because people see that they have a track record, then they can start to require that you're staying with me for at least 4 capital calls or things like that. And so they can put their own rules over. But it supports the things that a normal fund it supports: management fees, what we call net carry across 8 quarters worth of deals, things like that.
Interesting. We may come back to that, but I'm going to let Steve ask. Steve's got his hand up, so Steve, go ahead and ask your question.
Hey, Kevin.
Hello.
That's really interesting from the investor side. I'm kind of more interested from the investee side. Can you give us a sense of the distribution of deals, what it looks like in terms of, you said they're all priced rounds, what would the range be, how much are they raising, that kind of thing?
Yep. So the companies these days, so it used to be you could raise a $250 check and make it a significant distance. Interestingly now, people will view this different ways. The companies tend to raise somewhere between $1.5 and $3 million these days. Some people have interpreted that as companies need more money. It's gone back up again. I don't interpret it that way. I interpret it that the $100,000 check has dropped to a $0 check. People kind of create the first product and traction and things like that they used to need that first check for, just with engineers who are working on their own time and some clever tools. So it's kind of that first round post some traction. And it's in the $1.5 to $3 million range for the total round raised. The amount raised from an angel list syndicate will average about 250,000 of that $1 to $3 million, $1.5 to $3 million round, with the rest being taken up by funds, off-platform investors, things like that. That's probably, I'll call it 80% of the flow through angel list is mostly these technology seed deals, 80% by count of deals. There's another 20% that are follow-on rounds in successful companies. You know, TransferWise in the UK raised their initial round on angel list. I think they were valued at like $5 million pre-money at the time. I don't know what it was, don't quote me on that, but you know, they're a huge company now. They've raised Andreessen Horowitz rounds. We've raised rounds of where we've put in through AngelList, investors on AngelList have put in $3.5 million into a financing round that was, you know, $30 million led by Andreessen Horowitz or whatever. So
Kevin,
those are.
Sorry, just to tie this back to something we mentioned yesterday for the class. We talked about this phenomenon that off and on gets called the Series A crunch. And the phenomenon Kevin mentioned, which is companies now can sort of skip their first round almost because they don't have to spend $1 million on a Sun workstation. They don't have to spend $1 million in storage with EMC, and they don't have to spend $1 million on an Oracle license. They rent all that from Amazon, and the software tools they use to develop the product are mostly free. So you have this proliferation of companies that is, you know, that universe is expanding faster than the universe of venture funds, although that universe is also expanding.
Yeah, that's why we're working on that. I mean, that's exactly what happens, right? Is I actually, Series A crunch, I actually think is even the wrong term. Like you just have a whole bunch of startups that can make it a lot further on less capital. So there are more of them that have that much traction. Some of them will not go any further. And so yes, they're going to wash out, but those are the ones that used to wash out before just because they couldn't raise their seed. Some of them, but there are more companies that are investable also at the same time, and there aren't enough funds to do those. So that's part of why we're moving up with these rolling funds and things that can put much larger amounts of money to work in the companies that are succeeding.
But in terms of the scale, then, Kevin, your traditional maybe $100,000 or $200,000 angel investment from an individual, those wouldn't go so much through your platform. Those would be done privately, and then the next stage would come through your platform. Is that a fair sort of
yes, if it's right. So what's traditionally been called the friends and family rounds would not flow through our platform, right? Those are because they're done on so little capital, and at that point there is literally nothing. Like, it is probably not even a PowerPoint at that point. It's a set of conversations that you have sitting down and somebody's like really trusting you. That still has to happen. I mean, it's I wish, like we've talked about it every time I've come back. It is my wish to help solve that problem for companies, because we started there, but we grew too much to be able to do it. And it's not a scale thing. It's it's still a thing that can't be done online. And that's where I say, this environment might be very interesting for moving some of that activity online, right? Might be via Zoom. It'll still be personal connection, but it won't be personal connection over coffee. And so there is something happening here that might change that. I'm actually going to be traveling to Europe. I got special exception because of the business nature. Normally us Americans aren't supposed to go there these days. And looking at places where it's like, great, actually, if distance is going to matter less, maybe there are a bunch of places now that could really step up in terms of their founders making connections to good advisors and funders who could help them build them in this environment.
That's true. I mean, if the paradigm was always, oh gosh, you've got to have 5 physical meetings with a person, then, you know, Berlin companies get funded in Berlin and London companies get funded in London. But if that's no longer happening, why does it matter? I suppose that's a really
exactly. And I don't know the answer. It may be that it turns out it's just harder and there will be less good financings. But I have a suspicion that we're figuring this out. We got forced into a remote world, but there are some benefits to the remote world that may come out of this.
And indeed, I don't know about you, but it's a sort of relevant thing as well, because it's not just the initial decision, it's also the board meetings. But my view is that board meetings work better online than actually in physical. I don't know whether you or Alan agrees with me, but that's my
I haven't noticed a difference, put it that way. There is some bonding that happens pre and post board meeting. It's not the board meeting itself that is missing from that. You know, you're done, you hit end and everybody's gone, right? There isn't the kind of conversation afterwards of, well, what kind of deals are you seeing? Those kinds of things don't happen as much. But it's not that they're going to go away. We need some way to do them. I started to have some virtual meetings with people where we just catch up and talk, and that wouldn't have happened before. We were depending on serendipity before. We need to make it intentionality now.
Yeah, my view is it depends on whether the board meeting is at Steve's house or elsewhere.
Yeah, one of the students, Francis, is saying we're all going to go to avatars, and we've actually investigated this. So a colleague at the business school is going to use this for a conference, and yeah, I don't know if you've seen them, but the avatar, you could all become avatars in April.
All right.
Be
I like it.
Down.
Yeah. Well, we're going to explore it. We're all remote right now. I mean, it was interesting because like one day we were in the office and we were looking at the COVID stats and we're like, we're not going to be in the office tomorrow. So we told everybody, pack up your stuff today, take it home. As of tomorrow, we're all on Zoom. And, you know, it was a one-day transition and it worked fine. So,
yeah. and we're all still here several months later. Yeah. So it's yeah. Now, Imani had a question in chat saying, "What's your revenue model?" I love that question. I always ask it, but now somebody else has asked it, so that's a good one.
Yeah, it's a good question. So I touched on the business model at the beginning, but I'll dive down a little more into it now that we've talked about the venture side. So Product Hunt is easy. It's advertising. Companies pay us because they're launching products, usually big companies. Zoom was paying us for a while recently, and then Zoom competitors like Blue Jeans and stuff, because they're trying to reach that market. That's just pure media. The recruiting is easy. It's just a fee they pay us for access to a curated part of the platform where we go through the resumes and say, you should talk to these guys. That's a paid product, and so they just pay us an annual fee. It's in venture where it gets interesting, because we take basically, well, I'll say now 3 revenue streams, although one just disappeared. One revenue stream is we take a percentage of funds under management. When the GP takes a management fee, we'll take a piece of that for managing the fund on our platform. That's a cash flow. It's nice, but it's a weird one, because funds can be 5 or 10 years, and so we're getting paid over 5 or 10 years, not all up front. The second piece that's very interesting is we take a carried interest, especially where the GP met their LP on our site. So a typical fund will charge 20% carried interest, meaning they get 20% of the profits of any of the LP's invested money. Of that, the 15 of that 20% goes to the GP, 5 of that 20%, if we made the introduction, goes to AngelList. And that is a weird business model, because that's, call it bookings, it's not revenues for a long time. Uber raised on our site in 2010. It was 2019 before the lockup came up on the shares that they. So it was 9 years, and that is rapid that was pretty quick for Uber growing to that size. So it takes us a long time to get money back on that. But we'll just get these surprises of, here's a $2 million check from something that was done in 2014. Okay, great. Though it's a buildup of revenues that come from things we did many, many years ago. And then the third business model, which was awesome for about 6 months and has disappeared, is there's a lot of money sitting on our platform in transition from investors to companies. The float from that money goes to us. Interest rates are now 0, so that revenue stream was nice for 6 months and is now gone. But it is, it's probably $1/5 billion right now and climbing fast. So as more and more people run their funds through AngelList, so that by itself can turn out to be something fairly interesting once interest rates start going up again.
Yeah, well, don't come to Europe, because you get negative interest rates here. It's a way to ruin your business.
I know. No, I'm not gonna rely on float there.
Yeah, and tell me, I know that I've been reading some of the documents that put out. For those of you who are like me, who are a bit nerdy and like to see data, AngelList now got a data scientist who sort of crawls all over the data. So do you want to just tell us a little bit about what you found out about the returns to very early stage angel investing, in terms of the average return and the distribution of returns?
Yes. So the average return isn't that interesting, and I don't mean it's not good. I'd have to look. It's like 15% IRR or something. But keep in mind, that's unrealized IRR, meaning a company raises a round at a higher valuation. It's not really a return. You haven't got the money back. And that's just a function of our age, meaning most of the investments that have ever been made on the platform are still going and waiting to someday become liquid.
And so sorry to interrupt quickly for the class. We're going to talk about unrealized gains, IRR, and other matters later in the course.
Yeah.
No, we did
So
it yesterday.
realized gains are much better measure, but you don't get them for 10 years. So it's hard to measure. But the more interesting part of that is the distribution. That's why I was saying average is not meaningful. The distribution of returns follows at the earliest stages an extreme power law, not a bell curve. Meaning in plain English, Uber, when it went public, returned 2,500 times its initial investment to the investors. So let's say you made 2,000 investments and one of them was Uber, that's a reasonable return. Or let's say 1,000 investments, one of them was Uber, you made 2.5 times your money, even if everything else lost everything, right? And the intuition behind the math is basically what he found and was showing mathematically is that you're really trying to reduce the chance that you miss investing in Uber. That's the goal of early stage investing strategy, not trying to kind of get a good average return across a bunch of them. If you get a bunch, if you're looking at chance of failure, you're going to invest in a bunch of safer businesses with lower returns. You might get the same return. You might get a 2.5x if you invest in a bunch of companies and 100% of them do 2.5x. But that's not the way early stage investing works. Most of them go to zero. So if you do 5 investments, you will most likely lose all your money. Well, not quite. It's not that extreme. But in my example, you would have to do 1,000 investments before you're sure you picked up Uber. And there, what he was showing mathematically is, and I'll come to the complexity here, but there is actually no number of investments where adding one more investment doesn't increase your expected return. If you, for investments of a certain characteristic of returns. Now, he did a lot of work on that. Like that sounds interesting, but it's not like you could go out tomorrow and say, great, I can just make a whole bunch of money investing. There's 2 key important things in that phrase. One is investments of a certain characteristic, meaning they're early stage, you're not doing later. It's not just technology investing. It's not investing in Uber when they were already worth, $50 billion. This is investing in these early stage companies with extreme outcomes. And 2, and just as interesting, you are investing within a credible pool. You're not just writing checks to everything, that would be 30,000 companies. And so making 2,500 wouldn't have helped. It is investing within a certain credible pool of companies. And it's the definition of credible pool of companies that gets very interesting. And that's where a lot of our work goes, is what defines that credible pool, so that you're not wasting money on something will go to zero and are instead focusing on things you don't know if they'll go to zero or to the moon.
Right. Interesting. And just one, I'm going to bring Charles in a second, but is that why you've started to set up these funds which you yourself are running, which they're almost like index funds, aren't they? Sort of investing in anything that sort of looks and feels like it's a credible.
Looks and feels credible. Now, we can't call them index funds because there's not actually an index that they're tracking legally. But yes, that it's the same principle of the index fund for Vanguard. Like, if you want to understand what AngelList is really doing, go listen to some of the interviews of the founder of Vanguard, John Bogle. Vanguard is one of the largest fund managers in the world, in the US. But they went for many years being very small, promoting this idea of passive investing and not changing, until suddenly, year after year, they would return better returns. Interestingly, not because they were better at picking, just because it's cheaper to do these passive investing vehicles that they were coming up with. And so it was the fees that weren't coming out, and those fees compound over years. So they had these amazing returns compared to active investors after many years. Now, like, trillions of dollars are moving into them. So it's a big thing. But we believe very much the same is true at early stage investing. But we have to be very careful not to relax that criteria, because people won't know for 10 years of what makes a credible deal.
Yeah. And sorry, Charles, I'll come to you in just a second, but just to finish this off. So in the early days when you set up these pools of capital, which are sort of I forget what they're called, the access funds, are they, and things like that?
Access fund, yes.
Yeah, so those, you were making decisions, weren't you? Like you, Kevin, were making decisions, whereas aren't you trying to replace yourself with AI now?
We are. So we're about halfway there. There's an investment committee. I'm one of them. There are three of us, Naval, myself, and a guy named Parker Thompson, that vote on the deals. 2 votes gets it through. But we are doing more and more with making that vote supplemented by the AI that pulls together predictions about the company. And again, you can't, in power law, predict the outcome of a company. That's not a thing an algorithm can do in power law scenarios. We can, however, predict that it will be in that part of the pool. And here's a very simple algorithm you can use, and then you can see how it gets complex there. But if a company cannot raise or does not raise a subsequent round of financing, it is not in the pool of fast growth companies, right? Now, if you think about it kind of deeply, it's kind of self-evidently obvious. But that does tell us that we can start to track what are the characteristics that could lead a company to raise a next round of financing. We don't have to look the whole way to the end and say, okay, here are the characteristics. You know, if they've got so here's one very easy one. Like if Sequoia is in it, it's likely to raise its next round of financing, if only that Sequoia is going to write a check into it. But guess what? That turns over another card. That's enough by itself, right?
Yeah.
And they really do tend to stay in that pool of potential moonshots. And so you're really looking for other investor signal. We use hiring signal. We found some very interesting results recently about them using our platform to hire before they raise the subsequent round, things like that. So we can use a lot of these signals to say, yep, this is in that credible pool of companies that may go to the moon.
Right, interesting. Charles, sorry, I'll hand over to you now.
Yeah, so how do you actually keep track of the success of the deals that the angels invest in? Because a lot of these companies are private, so that you can't have an algorithm that actually collects the data. So how do you know if the deal was successful, and how far ahead do you look?
Yep. So we use, so for our analytics, we tend to use next round of financing. We have started to use overall returns now that we have a long enough track record. We're still using unrealized primarily, but a long enough track record to see and do some analytics there when we're looking forward. But in terms of tracking the data, that's a big part of what we do for these angels as they're running their funds. They don't have to worry about it. What happens is there's a vehicle that is created, this single purpose fund that invests, that the manager of that vehicle is an angel list entity called Bell Tower. When the companies raise subsequent rounds of financing, they will need investor signatures. So they send us notifications that they're raising a subsequent round of financing. Within that, it contains what the terms are of that financing. So we know, oh, they raised from a credible investor at 3 times the valuation that they raised at when they raised that initial round. Often, we also have rights to invest in that round, so they have to notify us for that as well. Pro rata rights, they're called. So the investors get the chance to put more money into a company that is successful. So we track all of that in a system we call Comptroller, which is this giant system that has every company that ever flowed through AngelList, and every update of every valuation and paperwork gets attached to it. And sometimes we'll get notified via the press because we don't have rights and they didn't get our signature, but we'll then be able to go back and look it up and contact the company and get the data. So that's what Bell Tower does, is they're tracking these thousands of companies and their current valuations.
So I guess you will drop a company off of your sort of tracking once the angel exits, because he's no longer signing anything.
Correct. If the angel exits, then the fund is done. There's nothing for us to track.
Yeah.
So we don't purport to track everything the way Crunchbase or PitchBook do. Yeah. That said, our data where we do track is accurate, whereas their data is, I'll call it about 50% accurate, if that. So we look at our things like recently, just an interesting aside, PitchBook in particular gets their data from mid-tier funds. because those are the ones that need to be on PitchBook to find investors. The top tier funds don't report, angels don't report. Mid-tier funds are the ones that stopped investing. So suddenly PitchBook is like, investing dropped off a cliff. And we're like, it went down a little bit. It didn't drop off a cliff. The people who report to you dropped off a cliff. That's a different thing. So it's that data is very spotty when you get to PitchBook or Crunchbase.
So I know Steve needs to ask a question, but I'll just say the last piece. So you could be a successful exit on AngelList, but the company may end up failing in the future. But from what your view is, that angel investment is successful.
Yes, rarely, but that happens. And when I say rarely, angel investors tend to be buy and hold. Part of that is enforced on them, meaning that nobody says, I'm going to buy out your stake, and so they stay in the company. You know, when Uber went public, they only in the last year or two before Uber went public did they really have an opportunity to sell those shares. The companies themselves actually have transfer restrictions written into their agreements. So some of that is by necessity, but some of it is by, especially for funds, is by design. Is funds are, you don't want to look stupid to your investors, and it's part of your commitment to your investors to exit Uber at $1 billion when they go IPO at 30 billion or whatever it is, 100 billion. I don't know what their valuation is now.
Yeah. Can I just, before we go on to Steve, can I just ask one other question along a similar line, Kevin, which is that, do you know when companies essentially fail? Because I guess that might be become a zero on your system, because is there any worry that somehow the returns might be a bit better than you think because you've got the old NAVs at the last round?
Right. No, it's usually the reverse. When we dig, we usually have missed up rounds or have got them late. So we tend to understate compared to when we take a subset and we'll do some research. So we actually actively reach out to, so there's a whole valuation policy, but we actually reach out to companies if we haven't heard anything in a while. And if we detect bad news, we just write to zero. We don't write to 30% of value. If it's like, great, we see that they didn't raise a round and we see news that they laid off half their staff, it's just a write to zero. So that's the way we track them for those purposes. And honestly, it doesn't drive that much, the failure rate. It is really about the power law at the other end of that spectrum.
Yeah.
That is, they're expected to fail, though. So saying they failed a little earlier doesn't drive the results that much.
Yeah. Now we're getting towards the end, but Steve, your question.
Thanks. Just to clear my interest before I ask this question, I'm kind of a human capitalist by profession, but I'm genuinely asking for a friend here. That could you just talk about the importance of finding the right talent? I mean, it's interesting that you started an entire business unit to do that.
Yep.
So you sort of provide the capital, but you also provide the talent. What was the next
step?
Step?
It's everything. I don't even know how to describe how much it is. That was one of the findings of a study that one of the first academic studies that I got involved with some guys from Stanford and Harvard doing, looking at what top investors looked at in a company. And talent was the primary thing. So there is this academic debate. I don't think it's a debate among VCs. Alan, you can tell me of whether what they call the jockey or the horse, right? Are you picking the market and that the company's good at those early stages, or are you picking the team that's going to get you there? It's all team as far as the early stage investors are involved. A good team who's picking a bad market will navigate their way to a good market. You know, Groupon was collecting signatures for political campaigns and kind of figured out that this couponing thing was a lot more interesting and navigated their way there. Uber itself, like I sometimes bring to this session the original email that AngelList sent out for Uber, which was, we are doing 10 rides a night in the city of San Francisco, taking orders over SMS, right? And by the way, we just got a cease and desist from the city in San Francisco. That's what they looked like when people invested at early stages. But Travis Kalanick was involved back then. So were a couple other key players that people knew. Garrett Camp, and some of the other guys that had past successes behind them and were known to be go-getters. We're like, yeah, we bet on that team. And that's what people were betting on when they were betting on Uber. And it was the right bet. Their original business model actually wasn't that good. It was a company called GetAround and Lyft that came up with a better business model. But then Uber beat them at their own game because they were more aggressive at it.
Do you have any quick tips for how to hire the right talent? I mean, apart from using the Angel List recruitment service? I'm not in tech recruitment.
Yeah, I mean, the Angel List recruitment service is good primarily for something we don't do that the people do themselves, which is they self-select into being interested in working for a startup. Mm-hmm. If you find somebody who wants a job, a startup is a bad fit for them because there's so much that is all consuming about a startup that is not the same way if you were to go into internal IT at a bank, which is a perfectly fine job, but not all consuming. And so people self-select into that. You want people who are up for that. I am very big on compatibility of mission when you do a startup. It's like you have mercenaries and missionaries. Early stage startups are all missionaries, and you have to be in the same mission or you're just going to split pretty early. And so, you know, Google organizing the world's information or Facebook connecting the world, those are interesting missions that all the early people cared about a lot. Now, those are nice versions of it. They probably had more sophomoric versions of it, given that he actually was a sophomore when he made Facebook. But those missions are what keep that initial team together when you hit all the bumps in the road. And then the final one that I look for that is tough, VCs use this term, which I don't like, called coachability, because it implies that the VCs know what they're doing and the company doesn't, and you're coaching them. I think it's more about kind of ability to learn. Like you want somebody who's not going to give up, but you don't want somebody who's so bullheaded that they're sure of how to do it and don't learn from what the market is telling them, what the investors are telling them, what their customers are telling them. So you want somebody completely passionate about sticking with it who will navigate and tack as they learn new stuff and bring it to what they now know. Those are kind of the characteristics that I look for if I'm looking at a founding team. And then if I'm investing, I have to click with them, because at the early stage, it's not enough for me to think the company is going to make money. I have no idea whether it will. I have to think that I care about what they're doing. Otherwise, it's no fun for me, and there's no connection for me to invest in them.
Kevin, thanks ever so much. It's as always been a fascinating and wide-ranging discussion. But thanks ever so much for joining us, and we really hope to see you in person next year if we're back. Although goodness knows, maybe we'll do it. We'll do it again virtually. We'll have a mixture of
exactly
coming in virtually or not. I don't know. We'll have to see. But best of luck with the future and what's going on with Angel List. And we very much hope to see you again in Palo Alto sometime next year. But thanks again ever so much. And let's give Kevin a digital round of applause. That's right.
Yes, I like the new emojis on Zoom. I thought that was the best improvement. Thanks, everybody.
Thanks
it's very good to talk to you all.
Thanks. Bye-bye.
Bye.
So I think, Tim, we're going to be joined now by Mariana Senko, but actually we've had a few problems getting hold of her over the last 24 hours. Bryony, has she shown up in our waiting room yet?
No, not yet.
So it might be a time to sort of answer a few questions from the class, and then I think we give it 10 minutes. And we've heard from her over the last few days, but haven't heard from her today at all. So and she accepted our Zoom invite. So perhaps a bit of a Q&A, and then let's see if we can get a hold of her. And if not, then we'll try and get a hold of her before the end of the week.
Yeah, no, I think that's a good idea. So it's often the case that, you know, especially on these courses where you're running through lots of stuff at the same time. If people have got any questions or things which have been, oh, there's Marianne is there. So you're gonna have to wait for tomorrow. So we'll do that at the start of tomorrow. And
yeah, she's in. Shall I let her in?
I think.
Yeah, let her in. Let her in.
There we go.
So, oh, Mariana, nice to see you. Can you hear us? Oh, you're on mute.
Tess, can you hear me?
That's okay. You might have to just raise your volume a little bit. That's brilliant.
Got it.
Yeah, we just said goodbye to Kevin Laws, and
oh, lovely.
I was saying that we're going to be joined by Mariana, but I'm not sure if she's joining us or not because I haven't heard from her. So hang fire. And but you made a very Shakespearean entrance, so that's.
I'm so sorry, guys. I thought I thought we had confirmed on our end. So sincere apologies.
That's great. So thanks for joining us, and I think this is. We always think that these occasions are a real chance for members of the class to ask questions, but I'll start with a couple, and then Alan and Tim will chip in, and we'll sort of bring people in, posting questions in the chat. But so I think the class have read a little bit about your background, but I'll just recap for those who've forgotten that you are the co-founder of Future Ventures, and I like the way you put it on one of your interviews that you invest in heroic entrepreneurs who forge the future, which sounds very galactic. And I think your own background, as you started life as an engineer, research engineer, and then moved into investing. And for those of you who haven't had a chance to sort of catch up on Mariana's career, she was with one of the best known firms in the Valley for a long time, DFJ, Draper Fisher Jurvetson, and then moved to Khosla Ventures, I think, and then went to co-found Future Ventures. So I think we're sort of halfway through the way we're thinking about the course, or we take people from the very beginning of thinking about how you do a startup, how investors think about pivots, how you invest, etc. And I just wondered if you could start, Mariana, by giving us a sense of that the thinking behind Future Ventures, and how you pick the people you're going to invest in. What's your methodology?
Ooh, all the easy questions to start. Well, thank you again for having me. It's such a pleasure to join you this year. I'm sorry it's not in person. I suppose we're in interesting times. So my co-founder Steve Jurvetson and I founded Future Ventures a year and a half ago, and we did so mindfully, in the sense that there are way too many venture funds out there. If you start searching, if you have an idea to start a company, you start searching, who should I go pitch this to? There's the 5 funds that everybody knows off the top of their head, whether or not they've ever heard of venture capital, right? The Sequoias and Andreessens of the world. And then you kind of peel back one layer and you realize that there are countless venture funds. It's not obvious what the difference between any of them are. You have no idea what motivates these people, where their capital comes from, or how on earth they're making the decisions they are. But they're almost all certainly writing somewhat heroic blog posts about their brilliance and their vision for their portfolios. And within that landscape, we said, well, we don't want to create something that's just yet another confusing marker in the sand for entrepreneurs to wonder who we are and why we exist. And so we really questioned whether or not we should exist. Within that, we went around and basically spoke to founders who we had previously funded and said, why did you take capital from us? From Steve at DFJ and myself there, my time at Airbus Ventures or Khosla. And the resounding feedback we got was that while there are lots of venture capitalists who pay lip service to investing in these kind of more difficult technology stacks, there are a few who actually execute on that as their primary vision in the fund. Almost every fund has 1 or 2 kind of crazy deals, as they call them. And we find that to be actually a derogatory term. That the moonshot projects should not be considered the one-off good luck, most of my portfolio is enterprise SaaS, and then maybe there's an interesting technology company. And we decided that shouldn't be the case, that the people who have the types of technical backgrounds and visions to build foundational technologies and have a vision to do that in the landscape of a startup should do that with investors who fully understand and support them and who have that vision. And so that's our existing principle, is that we only invest in technologies that are kind of first principle physics foundational breakthroughs that we hope make the world a better place, and specifically don't prey on human frailty. And so those are the metrics on which we decide how to invest. That said, it's not entirely a random walk, but it's certainly every investment is its own creature. Right now, we're looking at a company that is growing a meat substitute product from a new type of mushroom that they discovered, and specifically a mycelium, so the kind of root of the mushroom stock. And so, you know, there's all sorts of questions there, which is how does that compare to the rest of the food and alternative protein and alternative meat industry, and how do we feel about these founders, and how do we feel about these markets? And it's very different than our last investment, which was software in the construction industry space. And so what we're willing to do as investors and as a small team is constantly spin up a deep diligence process in sectors of interest for us. And also raise our hands and say, we don't know everything. We'll likely get it wrong a lot of the time, and we're only 2 people. So we're somewhat bandwidth limited in how much we can manage at any one time.
Yeah, so some of the sectors that you're involved in, the deep learning, robotics, genome therapy, meat, made up meat, and all the sort of, you know, clean meat, I think it's called. We're sort of in that frontier zone a while ago, but now don't seem so much in that frontier zone. But what would you say were the sort of really the specific things you have to think about, or are there different things you have to think about investing in, you know, a company that is looking at genome therapy compared to, you know, software as a service? I mean, it's an obvious question, but I mean,
No.
Is it how you do the due diligence? Is it the kind of people that you're looking for something different?
It's a fair point, and it is worth noting that there are some similarities, right? So I think the basic questions across any early stage investment, and we should preface there, which is we are reasonably early stage investors, so seed, Series A, the occasional Series B. We're a $200 million fund, so we write $1 to $10 million starting checks, with our sweet spot being somewhat in the middle of that. So when we're considering that first, you know, $2 to $6 million check into a company, we ask the basic questions, which is why is this technology interesting? Like, what is it foundationally different than what's been tried before? And that's why for us, while it seems like a crazy mix of technologies, it actually makes sense that we're kind of constantly on a moving target of the kind of frontier of technology, in the sense that we specifically we only invest in things that are unlike anything we've seen before. And that answers a lot of the question of why this technology. So if it's truly unique compared to anything we've seen before, or that we can reasonably guess exists, or that we can search out, then we at least know that there's some unique quality and flavor, and ideally some defensibility around that. So the first question is kind of this, why does this idea exist? Why is it unique? Why is it defensible? And we can talk about the patents and IP later. I think our vision around that is not terribly pedantic. The second is, why this team? So why is a team particularly well suited? And this really matters in these deep tech spaces. So it's one thing to have an interesting aha moment around a material class. It's a different thing to have a team that, by virtue of its talents, assets, diversity of cognitive thought, has inherently a system in place that will keep them kind of iteratively on the forefront of their own technology space. So we really care about companies that are process defensible, in the sense that they, as a result of their team and the unique capabilities of those teams, can continue iterating and moving faster and experimenting on kind of the edge of the space that they already exist. And then the third question is, why now? So as early stage investors, being early is just as bad as being wrong. Now we have a slightly longer time frame than most, so we have a 15-year fund, which means that we don't require our portfolio companies to be profitable in the first 2 or 3 years of our initial investment. They have a bit of a longer runway. That said, if they are trying to push to market something that is well beyond the scope of what anyone is willing to do or engage in, then it's just not going to work out on the time frame that matters. So examples of this are, I've been looking at messenger RNA therapeutics companies for I don't know, 6 years, and just made my first investment in the space this past year because I finally felt that there was enough of an impetus in the market in general, in an understanding and a proclivity and a desire to engage with these therapeutics, that we felt that the time to market to bring these therapeutics was finally crossing with technologies that were better at creating them. And so you kind of have to look for these market tailwinds that suggest that your new technology is actually at some interesting implementation point, and that's the hardest to guess at. We get that, everybody gets that wrong all the time, and I don't know that we're statistically any better than anyone else.
So with companies like this, where there's a big research input and you don't know how long it's going to take, or there's a further lead time to seeing where that sweet spot is, can you say something about how those kind of companies end up pivoting, or some of the pivots you have encouraged or witnessed or agreed to? We had a session earlier on with the founder of fab.com, which was an amazing session, and Alan worked with him a lot, Jason Goldberg, and he was saying that he really trusted Jason, and therefore whatever pivot he was going to make, he trusted Jason to make that swiftly and in the right way. But it's with very science-based companies, this is more of a complex thing, right?
Oh, absolutely. And we exist in an interesting space. So for example, biotech investors have been doing this for decades. And the way that they structure it is basically technology milestone-based funding events, right? So they basically say, you're here, we promise tens of millions of dollars into you, but only if you hit these mutually agreed upon next step milestones, which generally have to do something with either cell line stability or some outcome of a clinical trial. And this is basically a wild risk profile, and the way that biotech investors are generally rewarded is that they end up with huge ownership stakes. So 70 to 90% of most biotech pharma companies that are funded by biotech dollars are owned by those investors. That's a very different script in the tech VC and normal VC world. We as venture capitalists tend to own somewhere between 10 to at most 50% of a company, and generally feel that if the investors own more than 50% of a company, it's a raw deal, because then how do you actually keep the team motivated to continue slaving away on these companies when risk reward for them starts strictly falling off. What we try to do is essentially before we invest, to have real conversations with the team, also with world's leading experts in the fields of interest and relevance, and say, and we do, despite our desire to invest in these groundbreaking technologies, there are very few investments we make that really require kind of brand new foundational research. And this might sound at odds with what I was just saying, but the way that I think about it, right, is I'm a recovering engineer, is that there's like first principle theoretical physics, biology, chemistry. That is really hard, incredibly expensive, takes decades and a good bit of luck and excellent research facilities and a lot of patience. Now you can get lucky betting on those things. You can set yourself up for success by investing in teams that are uniquely talented. And we've seen this happen over the years. So company in the space is Vicarious. We're not investors, but it's basically a team of AI experts who said, we would like enough capital to be able to just do first principle research for the next 15 to 20 years. In the process, we promised to figure out generalized artificial intelligence. And we want to do this from a perspective of a company because we think that we spend too much time writing grants and it's not a good use of our mental fortitude. They raised tens of millions of dollars basically on that story. I personally think it's a bit of a risk. Another company, one that we are investors in the space, is Neuralink, Elon Musk's brain chip interface company. And that is one where we saw that they were building off of a back of a lot of established research, but that there was an enormous amount of research that still needed to be done, foundational research that can really go either way. The reason we got confidence there is honestly that Elon Musk's companies are excellent at raising capital. And we determined that, okay, if you're going to start from that early stage of foundational technology risk, then you have to do so from a place where you can raise hundreds of millions of dollars basically on the promise of your intelligence. So that's kind of the one bucket. That's the far end of the spectrum of these just invest in research ideas. Where we try to sit is that translation between, you have high confidence that the basic physics, chemistry, biology likely is going to work. There's likely decades of research behind that suggesting that it's trending in the right direction. You have some unique process capability or aha moment about how to bring it up at some meaningful scale, or a new take on which market this will be most useful in. And then you're in this interesting space of, you still have some core research problems to solve, but the majority of the problem is around the engineering and scaling systems. And so like excellent examples of this are companies like SpaceX. Like no one had built a reusable rocket before SpaceX did, but everyone agreed that it was doable. It was just a question of, it's doable, but is it doable at a cost that makes sense to anybody? And so that was one where you're really investing in like a systems process and engineering control. And that's where I think we as investors can be quite useful and thoughtful and help pattern match.
So
can I just ask a question about going back to something? It's Tim here, Mariana.
Hey, Tim.
Good to see you. And I was really struck by what I hadn't realized, that your fund had a 15-year life. And
yeah.
I always tell people, because you know, one of the negative, or one of the dangers of doing a course like this is people think, that sounds a really great job being a venture capitalist. Maybe I should form a fund. And it's my job to tell them it's like it's the hardest thing in the world to raise money. And it sounds like an even harder job to actually raise money and get a 15-year life for your fund. So how come? How did you do that?
We swindled everyone. No, I'm kidding. No, I think I'm very fortunate in having a brilliant co-founder, Steve, who has a long and successful track record. I'm equally fortunate that my own track record generally looks quite positive. And what we did, which was a little bit different than your average venture fund, is we went and said, specifically, we're looking for investors who have a longer version time horizon. And that meant that we primarily raised from family offices, wealthy individuals in the tech industries, people who really understood the time scale. And we actually turned down some capital because we felt that they didn't quite understand the risk profile that we were going after. And so I think it was not an easy process. I think both of us had our brains leaking out of our ears for a good portion of the fundraising process. But we felt very committed to this in the sense that we looked over our careers, the courses that our companies have taken, and said, it just doesn't make sense to try to put capital into these type of companies and then try to extract that capital 5 years later in a 10-year fund horizon. Like that's not going to close. We really need investors. We need and we need entrepreneurs who can operate on a longer time horizon. And similarly, right, it means that the reward for us for the majority of our careers is the joy and the privilege of supporting these companies. And from an economic basis, it's so far down the line that you just kind of cross your fingers and hope it's useful. But in 20 years, we'll find out if this is a good plan.
Yeah, I mean, looked at slightly different direction, you know, that could mean that you're going to have to wait a long time for any carried interest payments, doesn't it?
No, exactly. No, exactly. Like our right, our value of doing this in terms of economic reward. Like I joke that venture capital is my get rich slow with low probability scheme.
Yeah, no, I mean, that must be, because I guess that, I don't know, because we're getting into the weeds on the way carries paid, but are you on a US waterfall or European? Do you get paid on whole fund basis, or because whole fund could be like, if it lasts a bit longer, you could be 20 years from now before you get carried interest.
That's actually exactly true. So for Steve and I, that is exactly how we've set up our fund, because we basically said, you know, we're certainly not going to make we're not going to make money before our LPs do. Now we survive on management fees, but you try to limit those in the sense of the less you take, the more goes into fund and into the companies. But yeah, it's basically this is a 20-year bet minimum.
Yeah. Interesting.
Mariana, it's Alan Morgan. Oh, sorry, Tim, did you have another question?
No, go ahead, Alan.
Go ahead, Alan.
How do you interact with co-investors? Because your strategy is super interesting, but is unusual as well.
Excellent. Hi, Alan. It's a fair point. So we're fortunate in the sense that there are a handful of others who I hope, although we'll find out in the long run how true this is, have similar mentalities. So and it also means that we kind of have the same cast of characters going around and around again. So my former alma mater, Khosla Ventures, is another fund that really understands the challenges and timelines of these investments, especially in their later funds. Vinod somewhat jokingly says, you know, he's made he's done well enough that he has the freedom now to do things that he thinks are bigger and higher risk, but ideally more impactful. There are funds like Breakthrough Energy Ventures, which is entirely focused on global lowering of greenhouse gas emissions, and they understand the timelines on which that's important. You have funds like Lower Carbon Capital, which is Chris Sacca, who was an exceptionally talented and successful enterprise software and consumer tech investor who retired, realized that the world might be going to hell in a handbasket, and is now really motivated to help fix the climate. And so what we've been fortunate is that there are a handful of funds, LPs and otherwise, who have the privilege of having a bit more patience. And so we kind of keep those as a first circle of close friends. Beyond that, we also understand that there are lots of things that funds can do to move their positions to gain a little bit of cash. So we work with lots of early stage seed investors who we know probably can't have quite the same horizon that we do. But for example, 50-year VC 50 is a fund that's a seed fund that's entirely focused of how does their portfolio make impact in the world in 50 years. And so their LPs similarly have, they're not waiting 50 years to get paid out, but they have a similar mentality, which is if something is looking like it's doing well, they're not motivated to extract, to move their position. Other mechanisms that exist is that earlier investors can sell some shares, right, to gain cash. So there's always ways to start moving your position in a fund well before the exit of the company. So I think like SpaceX has returned over $1 billion in gains to DFJ LPs, despite the fact that DFJ is still an active investor, right? So there's kind of an opportunity in a lot of these companies to start moving your position around, and we trust that some of our co-investors will act on those moments. Sorry, that was a long-winded answer.
It was good though. Thank you. How do you think about or work with or avoid, or whatever the right verb is, national laboratories and other sort of research institutes that typically do, focus on more foundational sort of research matters than a startup can afford to do?
Yeah. So one of the things that we really love is that more and more of these national labs are thinking about how to use the private sector and civilian markets to accelerate their own technology progress. And so you have like Argonne National Labs that has an accelerator. Most of these national labs actually now have some type of startup accelerator. And one of the easy ways for us to engage with them is to essentially cherry pick through those companies. The vast majority of them are really interesting projects, do not look like terribly viable venture scale businesses. But every once in a while, there's something particularly interesting there. Another way that we operate is once we invest, we often go to the national labs and say, hey, you guys have a research division in this, or you have some grant money allocated, or RFP, request for proposals. And so we do everything we can to ensure that if research dollars exist, if government grants exist, that our portfolio companies are aware of them and taking advantage of them. You just have to make sure that those are really tightly aligned visions, because it becomes very easy to be a startup that's science-based, that's operating on this continual methodology of winning grants, which can be at the cost of them building a commercial business. So I would say we generally have very friendly and positive interactions with the national labs, but are cautious when they give us a call or send us a list of potential startups and say, here's the next 10 SpaceXs, because it's generally, they're interesting ideas, but they more often than not are so technically in the weeds that you have to squint really hard and think about how does this become a large sustainable company in its own right.
Great.
I was just looking at your website last night, Mariana, and the sort of range of investments, and there's three. So you've got Deep Genomics, which is very, very sort of involved obviously in genome research, and then Memphis Meats, which is the man-made meat. These I assume are the mushroom, the mycelium growers. And then you've got MedCorder, which is an app helping people get more out of their time with their doctor. Now, they are all so different. Can you sort of give us a little bit of a flavor of how you, well, how you led the funding round and what your thinking was behind each of those three, just to give us a little bit of a sense of how you pick those entrepreneurs and those ideas, and where you are with them now, what sort of stage they're at.
Yeah, absolutely. They're interesting because they're all different. I might throw in a Thai Life Sciences as another interesting
You can
example.
choose something different if you like, but I was just intrigued.
No, yeah. So one, I'll preface with, I promise I'm not schizophrenic, although it feels like that when you look at our portfolio. We tend to have, so our fund is only 1.5 years, but Steve and I have been doing this for a bit. And so the investment thesis, right, they're multi-year methodologies. So let's start with kind of earliest to latest. So the earliest investment, actually it was the first investment from our fund, was MedCorder. And the reason we invested was David Weekley, the CEO, is a brilliant entrepreneur. I've known him for years through his prior startups, through his time at Google and Facebook. And he had a really moving life story. He had 3 close family members with terminal cancer illnesses, and really had firsthand experience of just how awful it is to engage with the care of team givers in medical facilities, try to match and understand all of that information and disseminate it across the broader care team of the family. Patient information retention between patient doctor consults is somewhere between 10 and 30%. So, which is terrifying, right? Your most important information, the life-saving information that your doctors are giving you and that ideally you're passing on to your families, you're receiving somewhere, at best 20% of what you're supposed to be understanding. And David is a brilliant engineer, AI researcher, machine learning scientist, and he basically came to us, no team, a vision slightly of what to do, and a real understanding of this problem. And he said, hey, if you guys support me, I promise you I will build a solution to this. And so that was one where we had a deep foundational knowledge of the founding team, a really strong story, a vision for how a technology platform can really meaningfully impact patient lives and outcomes. And so they've actually built the app and are now in trials at UCSF for 3 clinical trials to prove that this app can actually improve patient outcomes. We were the first check into that company, and it was a seed investment. And so I would say there wasn't really any technical diligence because there was no product. There was a lot of faith in David.
And what was the other seed amount? How much did you invest?
We invested just under 1.5 million in a just over, I think the whole round was about just under 3 million. So we led the round and took about maybe a tiny bit more than half of it. And so that was, I would say, a unique situation where it probably would have been hard for us to do the same investment had we not had the same type of relationship with the founder. On the flip side, on the other side is Deep Genomics, which is a company I had tracked when I was at Coastal Ventures. Coastal actually led the Series A. I've been reading about, chatting with researchers and tracking messenger RNA therapeutics for at least 5 years. And so it was a team that I basically hunted for. And when we started this fund, I thought it's probably out of scope. It's a Series B, we do more Series A's, but I was so excited about what they were building and how, and they had just announced, basically in time with the funding, they had announced the first the first therapeutic discovered using artificial intelligence to a previously untreatable disease. And we were so excited about this. It fit our thesis of basically making medicine more digital. And we spent, we spent months and months and months getting to know the team, doing diligence on the team, speaking to researchers in the space, speaking to pharma companies, just trying to understand if we do a risk of doing a Series B in something that really looks like a therapeutics company, does it make sense for us? Atai Life Sciences is another company in the biotech space that is using psychedelics for therapeutic investment, for therapeutics, specifically focused on depression, anxiety, and substance abuse. And so basically the psilocybin, which comes from magic mushrooms, R-ketamine, which is a synthetic construct, DMT, which is a psychoactive compound in ayahuasca. And the aha moment we had there, other than Michael Pollan's book, How to Change Your Mind, was that one of the biggest risks in any pharmacokinetic therapeutic is that you have no idea if the drug that you're trying to administer to people is safe, right? So the first thing you do in clinical trials is figure out, is this thing toxic? And if it's not toxic, is it effective? So safety and efficacy are the two questions. What's really interesting is that in the psychedelic space, as a result of lots of people, largely very privileged people, getting to try this out, you know, in camps with their friends and in their living rooms, we have a lot of data that's not FDA admissible, that these substances are very safe for human consumption. And what we figured out is that, oh, this is a unique opportunity in that we have high confidence that these are very safe compounds for humans to ingest. We have baseline understanding that they're quite effective. And you have all of the stigma associated with investing in psychedelics. So lots of people are, you know, just afraid to engage in the space. And we have the opportunity to basically have a really supportive group of LPs who said, yeah, go for it. You know, we're not too worried. This company looks like it's aligned on all the right factors. And so I think we're always looking for spaces like that where is there a clever mix of insights that make us uniquely positioned to make a move in a space where otherwise people would be nervous, concerned, or slightly uninformed. And so within that, essentially what we're doing is we're always scanning. We're always scanning sectors, industries of interest, and trying to understand what are their largest problems. So a thing I do is constantly reach out to university professors and just have a chat and say, you know, what are the 3 largest problems in your field? What are you afraid of? What is an unsolved problem? What is the thing that makes your head hurt? And so that tends to just lead to conversations that cause us to then go scan the spaces for solutions.
So we've got Fabian wants to ask a question. Fabian, do you just want to speak up rather than me repeat your question?
Yeah. Hi, Marina. Thank you for your talk. Very interesting. In this kind of investment that are like 15 years long, new technologies, next that you have a lot of due diligence on the team and in the idea, how do you monitor the performance of the companies? How do you know that they are going in the right track and you know they're going to start delivering the performance that you're expecting?
Yeah. Oh, this is the constant battle. So I would say first and foremost, I'm going to give an answer that makes my heart hurt a little bit, but is a reality, which is we're only a $200 million fund, so we can't single-handedly support these companies to their natural end states. But what we can do is knock down some risk factors such that further on investors are willing to put up capital at prices that make sense to the company, where they don't feel that they have to take on the same risk profile. And so generally what we do when we invest is we sit down with a company and we say, okay, we will fund you through your Series A or your seed round, but what is a technical milestone? What is a proof point that we have to hit that even if you didn't understand this technology, if you didn't understand why this is so difficult or why this is so important, it would make sense to you that this is now trending in the correct direction. So a simple example is when we invested in Memphis Meats at DFJ at the Series A, their cost per pound of clean meat, so they grow meat from stem cells of animals for food products. So the idea is a world without slaughter, a world without suffering, a world without antibiotics in the meat products we eat. A multi-trillion-dollar industry. Everyone agrees that it's doable. The problem is when we invested at the Series A, Steve and I at DFJ, the cost per pound for Memphis Meats to make a pound of their product was just over, let me get this right. I looked at this data yesterday. It was just over $200,000 a pound, which the correct thing to do is knock your eyes up and say, I don't care how nice that vision is, that's not a useful product for anyone. And what we got confidence on, what we did diligence on was, can you knock down this, can you show that you're coming down this cost curve? Now they already had for us shown that they came down from about $1.5 million a pound to 200,000. And we said, okay, you have to prove that you can get down to about $100 a pound. So so you get to about a $25 quarter pound burger, because that will work for investors, for other investors who know nothing about these spaces, who don't understand these chemical processes, who don't want to, but they will then be able to match you to Impossible, or to one of the to just thinking about how much they pay for a burger in a restaurant. And so we basically sat with them and said, how much capital do you need at the A, and what is your vision for getting down to $100 a pound? And that's exactly what they did. And so they ended up raising, it was a $22 million Series A in 2017. This past January, they raised $161 million Series B from Norwest as the lead investor. And their cost per pound was just under $100 per pound of product. So like the thing that we did with them over the course of those years was constantly stick to this market, because there's 1,000 directions that company could have gone. And every single time we came to a question of what should the team be doing, whether it was in a board meeting or a catch-up session, is, does this bring us down the cost curve? I mean, I think the team got so sick of us hearing that line from us, but it was us constantly reminding them, like, hey, you have one job in these next 3 years, which is just prove that you can come down this cost curve. A lot of these other questions of flavoring, whatever, like, we can solve them later, but if you don't come down this cost curve, nobody is going to care. And so for every company, we basically try to find, like, what is the marching order that even if you weren't as well primed in these spaces, you would look at and say, oh, that's interesting.
Thank you.
So I want to have a chance for other people to ask some questions. Wade, I think you want to ask something. Yeah.
Yeah, just following on Fabian's question, how much time do you spend with each of your portfolio companies? I mean, you obviously you got board seats, you've got catch-up meetings, like you said. Are you talking to them once a week or more often, or?
Yeah, so Steve and I have slightly different methodologies around this, and I think for every investor, it's kind of what their personal preference is. We both try not to take board seats unless we own about 20% of the company. That's simply because we're a 2-person team. We currently have 15 portfolio companies. If we took a seat at every investment we made, we quickly would run out of time. That's how we try to make ourselves available. Now, the flip side is that, unfortunately, when you make yourself, when you just say, call me when you have a challenge, it's the people who whine the loudest are the ones who get the majority of your time, and you want to make sure you're checking in on everyone to some extent, or at least making yourself available to them and their teams. I say I spend minimum 30 to 45 minutes with every portfolio company that I'm close to every week. So that's 6 to 7 founders every week. I have a weekly morning catch-up call, coffee. Well, now they're all Zoom coffees, but basically make a point of just calling in to chat, see how it's going, and be available. And often they're just friendly chats, which help us just build a better relationship. And sometimes they're, hey, I'm trying to solve this problem. Can you help me with some resources? And then we, on average, schedule board meetings for every 6 weeks. So you want to be, every month is a little too much. I like to have slightly shorter board meetings. So 1.5-hour board meetings every 6 weeks is better than a 3-hour migraine of a board meeting every 3 months.
If you were in Oxford University, you'd be used to meetings of 3 hours on a regular basis, Marianne. So.
Yeah.
Efficiency of meetings. Oh, come on, that kills me.
Yeah. Can I ask a question about how things have changed in the last 3 or 4 months? You know, with because we had an interesting chat. Kevin Laws made an interesting point that he's started to question whether this was proving that distance didn't matter for venture capital. You know, and I know, you know, there's been the old mantra that, you know, it's very much about being close together and, you know, having breakfast in Bucks and, you know, and lunch at Il Forneo and, you know, knocking into people. But do you think that's changing at all?
I think time zones still matter. Especially now that I think time zones actually matter more now because we're all zoomed out, right? So is in the sense that we're all sick of Zoom. There's only so many hours you can spend staring at your screen. It lacks the depth, complexity, and joy of in-person interactions. And so the idea suddenly that you have yet another video call, but now at some really off hour, I think becomes even more onerous.
Yeah.
So while I agree that distance, like in terms of San Francisco, Boston, probably matters less, I would actually argue that like San Francisco, London actually suddenly feels harder. A really interesting insight that we had among a number of our portfolio companies is distance matters less for hiring now. So there's a lot of people who are very talented who are suddenly making moves. Every company has had to figure out some level of remote work. Even our companies a lot of our companies, interestingly, by the type of company we are considered critical businesses. So SpaceX, Commonwealth Fusion Systems, which is a nuclear fusion company, all of our therapeutics companies, they're all still allowed, even in the height of the quarantine, they were all considered critical businesses. That said, every single one of them has had to figure out how to move some level of their workforce remote or partially remote. What this has actually opened up that we didn't expect is a larger talent pool. So people are now suddenly more amenable to, okay, I live in Boston, I don't want to move, but this company in Toronto is really interesting. I can do most of my job via Zoom, and I can, if I need to, I can travel there every so often. And so what we've been amazed by is that the spread of the talent pool has really widened across all portfolio companies and all sectors, which I was not, you know, if you're going to look for very thin silver linings in a global pandemic, I believe that's one.
Right. And are you seeing sort of activity drop off at all? You know, is it because I heard stories certainly in Europe of hardly any deals being done, you know, hardly any money flowing, governments intervening to sort of almost like, you know, sort of back up, sort of encourage fundraising by co-investing and things like that. Is that your impression as well?
No, because we're sharks here, right? And so everyone's of the mentality of when the entrepreneurs are fearful, that's a great time to be putting capital in. So what we found is that flat is the new up. So while it became hard to meet new teams, what I saw a lot of happening is rounds where people missed the A, or they didn't get in, or they didn't get quite as confident on the price. Now you're roughly half a year to a year later, and you can basically go to those companies that you saw a year ago and said, you know, we were really interested in, how's it been going? You get a catch up. It's actually trending positively, and then you say, would you be interested in a convertible note or a bridge to give you a little bit more runway? And you know, and it kind of has been working out in the favor of the VCs, where largely I would say the rounds have been flat. And there's the other comment though is, I would say, at least in the Bay Area, in the last month, I've seen a significant uptick, both in overall deal flow and companies that I think were very, very nervous about whether or not cap funding would happen for them are getting term sheets pretty quickly.
Right.
So I actually see that there was definitely a slowing in April, and now I would say we're back up to full speed.
Yeah, and that's interesting. So you're seeing some convertible notes or bridge financing after they've had priced rounds or two. Are you sort of coming
Absolutely.
That's really interesting. Yeah, and this is just because they don't want to have a down round. They want to sort of get through this and then get back to normal market conditions and the like.
We just did one of these. I just got a signed term sheet back for a convertible note into a company post Series A. The lawyers said, don't you guys want to, we'll reopen the Series A? And we said, no, a convertible note has more protections for investors. And the CEO said, hey, these are interesting times. It's definitely a buyer's market. So I see a lot of convertible notes happening right now.
Right. Yeah, interesting. Presumably these are with, so you'd end up, because we were doing convertible notes yesterday, but we're talking that actually most of them are first funding rounds. And in fact, funnily enough, you won't know this, but in the UK, the government came in to prop up early stage ventures, and they did a convertible note, which was later, could be a Series C or D or the like. So it's interesting how this is actually not just, I thought it, when we were looking at it, I thought it was unique to the UK, but it sounds like it's actually also happening there as well.
No, we actually see it very commonly, and even before the pandemic. I would say that the most common times to see a convertible note are between the seed and an A, where sometimes if it's internal investors, they'll almost always do a seed extension or a second, or like a seed 2, which will be an equity round. If it's a new investor, it's almost always a convertible note. And the same often happens between an A and a B, but a little bit less common.
Yeah. Now, I was going to pick up a question from chat, but Baoli says, I think the question is, is your intention always to see it through to the end? Or if there is, given a 15-year fund and you might want to get some sort of exits along the route, would you consider, if there was the opportunity to do a secondary sale to another investor coming in at a later stage, would you intend to stick all the way through to the end, or are you interested in secondary sales?
We're not particularly interested in secondary sales, and I will tell you one interesting thing, which is my co-founder Steve has never sold a single share of any company he has ever invested in, which turns out is a great way to not worry about market dynamics. So sometimes companies sell for cash, and then you can't do anything about it. You get cash, it's great. But a lot of times you get stock, right? So he's sitting on Baidu stock and Tesla stock, and so we actually hold that as a foundational principle, which is if we invest, we believe one of the questions we ask is, what does this look like in 20 and 30 and 50 years? Why does your company exist? And if companies don't have a good answer to that from the beginning, or at least an inspired one, we don't invest in the first place.
Yeah. Kathy, back to you.
Yeah, I don't know, Laurent, you had a quick question, but I don't know if you thought it was covered about sort of how you protect the technology and benefits of the research. Do you want to just add to that? And then I have a couple of questions before we close.
No, I was just wondering whether you had a policy to protect the technology, and if there was synergies across your investments that you can bring to the table while you do.
Yeah, absolutely. Great questions. I would say that we focus on rather than protecting, as in trying to keep. So there are plenty of businesses where you try to keep the process trade secret. So and often what we believe is that while we'd love to make money off of our investments, we also just want these technologies to hit the world. So we generally take like a Tesla style approach and encourage companies that, hey, make all your patents public, make all of your technology public. You never know what benefit will come back to you. Your real value is in the team that you can inspire to come in-house and work on your mission and iterate that. So if you look at, all of Tesla's IP is public. Most of SpaceX's is, if it's not ITAR restricted. we really believe that the quality of the team you keep and the speed with which they can iterate and experiment is the thing that allows you to continue beating the market, rather than holding some foundational trade secret patent technology. That said, this varies over time. And we absolutely do everything we can to ensure that our companies are learning from each other. And so whether it's on regulatory, so, you know, we spend a lot of time with our nuclear fusion investment talking about how SpaceX has dealt with regulatory challenges and connecting people across these companies to say, you seem like you're in different industries dealing with different problems, but I promise it's more similar than you think.
So I just wanted to sort of close on some general questions, really, and one which we haven't touched upon, but which I think is really important, is that, you know, you are one of a number of sort of women in Silicon Valley who are now making more of a name for yourself and becoming and having higher profiles, and that's also possibly as a result of the incredibly low profile that women have had in the past. And in the UK as well, there are attempts to sort of celebrate women in tech and bring more, you know, bring to the forefront those women who are in the industry. But, you know, for women who want to be part of the VC world, it's not always an easy route. What would you say to them?
Ooh, yeah.
Don't worry, we've only got 2 minutes left, Mariana.
2 minutes, yeah. It's easy to jump the hurdle of a low bar. No, I think, oh, this is such a hard industry. And I used to very much be of the mentality that, that we should live in a very egalitarian society, and people should be absolutely looked at based simply on their merits and not on any other division on which we like to bucket people, whether it be gender or race or age or anything else. That said, that's obviously not the structure or bias that we generally operate under. And so I think that the way that I look at it now is I feel very privileged and fortunate in my position, and I try to do everything in my power that now that I've kind of gotten in the room is to make sure that I continue keeping the door open for anyone else who does want to make this path. So I try to be a supporter and an advocate of women-led funds. I try to support women who are trying to start funds and introduce them to LPs and co-investors, and I try to make myself available as a resource and do everything I can to make sure that whoever wants to also come down this path doesn't have to figure it out entirely from scratch, because that sucks and that's not a useful endeavor. That said, I think the first thing that anyone has to do is recognize that that venture capital is a craft business. And it's one with where these institutional knowledge live within the organizations. And so I think it's really important to consider the groups you join and how they think about their own cognitive diversities and teams and supporting who's within them. And I've been really fortunate in my career to work with Steve, to work with Vinod Khosla, to work with people who had a more egalitarian and have a more egalitarian attitudes towards who's on their team. And so my suggestion is look closely at not the stated blog posts and morals of the groups that you would consider joining or applying to, but look at their actual actions. Because if you see that they have no women in their fund and that they don't invest in them and they don't invest in people of color and they, right, like I would say that might not be the first group you want to go after for getting in the door, because the uphill battle internally is so painful and there are so many battles to be had in this space.
Okay, thank you. Yeah, it's a tough question to end on, but I think it's a really, really important question, and I just wanted to make sure that we covered it. So
absolutely.
It has been fantastic. You've given us an hour of your time. It's been great. I'm just so sorry, Mariana, that it's Zoom and that you're not either in Oxford being feted in an Oxford college, or that we are not all in California really enjoying ourselves there. So hopefully next time, right?
Hopefully, I would love that. And I am absolutely available for follow-on questions. Please feel free to share my email with anyone in the class. And yeah, I wish you all well.
Brilliant.
Thank you very much.
Yeah,
thanks a lot.
Thank you so much. All the best.
It's a pleasure.
Bye-bye.
Bye, guys.
Good. So that's the end of day 2. And we're still running remarkably on time. This means that day 3 is going to definitely go off the tracks because it never operates like this normally. But anyway, hope you enjoyed today. I won't take any questions at this stage because I think that'll just annoy people. We'll start off the day tomorrow. Any questions you've got, there's a few in chat now which people are helping to answer. But if there are any questions you've got tomorrow, let me know. We've got a blockbuster day tomorrow with both Reid Hoffman and Brooke Byers back to back. That's a pretty good slate, right? Like having the Rolling Stones and Billy Joel, you know, sort of.
Yeah.
I'm showing my age there, but on the same thing. So
yeah.
Hope you'll.
Should we use the opportunity to just repeat the Chatham House rules? So
yes.
No photographing the screen and sending it anywhere. No Twitter. No, and particularly, well, with all of them, but you know, the guests are pretty stellar, so we lose our credibility if anyone does that.
Yeah, indeed. So anyway, have a good rest of the day, evening, afternoon, whatever, and we'll see you same time tomorrow. Thanks.